Yeah, went up high. We're back here with you. I was eating. I was talking to Anthony. Anthony's at the office. Hold on.
It closed at 306.
Closed at the highs.
Yeah, 3006. It's up to it hit highs 3012.
Yeah.
Oh my! I'm sick to my stomach.
I know.
Those SPY calls are probably another 70 cents.
I mean, they're huge. That was a huge call, Anthony. Huge.
Do you know how it happened? I had the VXX. I told you those calls.
Yeah.
The 25s. It gapped up to 73, 74, and then it was backing off. So I hit the sell order. I got out. It was like 69 cents. So I made 8 cents. Big deal. After
You know what? You know what I like about, though, when I talked to you? You could have easily said you held on to, and you were honest and said, I got out of this. You know, it's much higher, but I got out of it. You know, which was cool.
54%. I'm like, what the hell?
I mean, the options have been really good this week. I mean, I'm glad we're doing a show on options, and I'm glad that you're...
Well, you know what? I'm also glad that Rob's going to be talking about those spreads and stuff.
Yeah.
Because you always hear people talk about it, and I don't know anybody
You know
other
what?
than Rob.
Yeah, I mean... It's you know, I never... Let me see if this is working for you. Testing 1, 2, testing 1. This sounds good. This is Anthony's mic. So remember, Anthony, I should put a piece of tape on here.
I remember the words.
Audio Technica, but there's words on the back.
Well,
here,
you
but
always
it's
said the front.
the front words there.
And also you said this little button here.
Yeah.
That little thing there.
Yeah. And then we got Rob on the line.
Rob.
Here. Oh, I gotta give you headphones. I have headphones for you.
It's on the floor. And then he was hurting. He was in rough shape.
Rob,
With
I
his
didn't
back or
realize he was
something.
out. I thought he just didn't like me anymore.
No, if anything, he didn't like Paul.
Can you hear?
Rob?
I can hear you.
Can you hear, Rob?
No.
Because sometimes this sucks. This
Is the volume on maybe? The volume's not
No,
on.
the volume, match the volume. All right, the monitor. Sorry.
Rob?
Oh, God.
I'm here.
Never mind. Is Rob on?
Yeah, he's on. I hear Rob fine. Do you guys hear him okay?
1 second, I'll play with this.
Oh, I didn't turn him up here a little.
Oh.
There you go.
Test.
Sorry,
I hear
guys.
ya.
All right, Rob, how you doing?
Order filled.
We're just talking
Order
about
canceled. Order canceled.
Oh, no, hope only good things.
you. Frank, I just missed your call. Frank, I just missed your call. If you want to call back.
How do I lower this now?
Lower
one?
the
No,
audio.
the earphones.
All right, that's right here.
Perfect.
There.
Well, I heard you. I didn't hear Rob, so.
You don't hear Rob?
No.
All right. Well,
Anthony.
I hear you now.
all right. It's
Okay.
it's tricky there. I don't have a professional setup here.
Don't worry about it. Hey, how
Say the
are
least.
you feeling? I heard your back was all messed up.
It's a story for another day, but it's not good.
Oh.
Yeah, I could hear it in your voice today. Is it bothering you?
Oh, I'm sorry, man.
Yeah, it's awful, but
Oh, hippies.
again,
Hippies calling
I don't want to be a black cloud. But I've got some challenges ahead. Let's put it that way.
Yeah, I'm sorry,
I'll
man.
talk to you more about it off.
Are you listening on the show?
Ahead.
We also got Frank.
Yeah, I just literally.
Frank, you on?
Rob's on tight stops, and I'm with Johnny right now.
We're gonna have Hippie call in too. It's gonna be a
If you're not busy, you want to call in on Skype?
Beach Mom. Is that good for you?
Oh, okay.
I don't know. Tell Hippie what does he think now? You know.
Actually, wait, I got to talk to you more about that. I just got an Amber Alert. What the hell's an Amber Alert? Oh, it's Deer Park.
Oh, some kid's missing.
Oh, okay. Hip? Craig, you there? Hello?
Gain is too high on mine. Yeah, it is. A little too high on
Hey,
mine. All right, there we
let me
go.
give you a call back tomorrow.
You know, when we get the Skype on, everything gets kind of wacky.
Jeremy Siegel, who's basically a Democrat, was ripping Powell about only cutting 25 basis points. He said it should have been 50. He doesn't know what he's doing. He ripped into him on CNBC. I was on the floor laughing. What the hell's that?
I don't know.
That looks like a haunted thing, like he's going to murder somebody and we're
know,
going to
right?
witness it.
What is that? Frank, you on the line there?
The ghost.
I heard a look.
Jesus.
Hello?
Hello.
Was he getting locked up? I see a shadow.
On your site.
What was that?
I'm still getting ringing.
You're still hearing ringing on the site.
Well, that might be the fire truck passing us.
Oh man, is everything on?
Oh, man.
Is the show on actually?
I see the way this is going to go tonight.
Oh, yeah, it's going right in the toilet.
That's going as it usually does.
Oh, man. Come on. I got people listening into this.
All right, hold
Oh,
on.
really?
Let's get,
All
let's
right.
get straightened
Yeah.
out here.
Let's be politically correct.
No, we're gonna get straightened out.
No, seriously. Listen, I'll reschedule show if you're going to If you guys are gonna fuck around,
No,
seriously.
no. I was telling John
I'm-
before we turned the mics on.
I'm
I
in
want
pain, and I want to do this right, and I
No,
don't want
no.
to be, you know.
Listen,
Whoa.
I want to learn about the credit spreads. I was just telling John about it. I jumped in on those SPYs, and I really would like to do a spread if you want to figure it out on the Roku, because I really think 129, 128 is the bottom, and it's going to go back up from there. So I was thinking about selling puts to collect some premium.
First of all, let me make sure everyone can hear me right. Do you guys hear me out there? Frank, I want to hold off on you, Frank. I want to get this show professional for Rob. Rob is spending his time with us tonight. He has a lot of good information. He wants us to be serious. I'm not taking any calls right now. I want to make sure that quality of the show is at the peak right now. You hear Anthony and hear Rob, and it sounds great now. Everything sounds okay?
Order
All
filled.
right, so we're going to go with that.
Put a one in the room if it's.
Rob, are you okay? Are you satisfied?
Yeah.
All right, good. Because I'm excited about this show, too. And Rob is our special guest. Let me turn this up a little. I got to turn that up so I can hear you.
And for the viewers who don't know what I'm talking about, we have a tendency for shows to go astray, off topic, little colorful than we should be. So
Yeah, no,
Just
I wasn't
trying
planning
to,
on doing anything.
you know.
No, that's okay. Paul's not calling in, so we'll behave.
No, we're good. All right, so welcome everyone. Day Trading Radio special nighttime show. It is 8:06. We're right on time. I mean, come on. This is actually really good.
That's because you and Rob aren't together. That's why we're on time.
It's because I'm calling in from home.
Yeah, that's exactly right.
Tonight's show is going to be focused on options. We have Anthony, Trader Anthony. A lot of you guys see him posting many of his trades. He made a fantastic call today, and he tends to call in every day when I'm around and stuff. I mean, I haven't talked to him in a while. I just ran. Anthony just walked through the door, and he looked like he was a different person because he let his hair grow out a little, and he has kind of an afro, which is pretty fun.
Him and Dawit.
I got to share that with you. He does kind of look like Dawit.
Great. Now I look like Dawid.
No, but not all like Dawit. It was funny though. I said, well, he looks good. He looks good. I haven't seen him in a while.
Hey, down to 172 pounds.
172 pounds.
Yeah.
Got
Oh
the
my
afro
God.
going.
You're 100 and nothing.
Rob, all kidding aside, last week I got down to 168.
Wow.
That intermittent fasting, I swear to you, it works.
Paul has said he's starting to fast now today.
Yeah, but he fasts for 1 week, loses 10 pounds, and puts on 20. He does it wrong.
Yeah.
It's going to kill him.
Well, I heard, more and more things. You know what? More and more people are saying fasting is the way to go. I always believe that less eating is more healthier.
Well,
We eat way too much.
the intermittent fasting is basically you have an 8-hour window to eat, and you fast for 17 hours. So I always do the last meal I have to the first meal in the morning. It's got to be around 17 hours. You can have all the liquids you want.
So you eat like a lunch, you're saying? You don't eat
Basically,
your breakfast.
I do away with breakfast.
I do that too. I do that anyway.
But
That's
you,
what I
but
do.
you already do that.
Yeah, I do. That's why
But-
I'm in such good shape.
But all kidding aside, the reason why it works, and you read up on it, the HGH levels in women go up 1,300%, and in men it goes up 2,000%, and you have to do it 4 or 5 times a week.
You lost me on HGS levels.
No, the HGH, human growth hormones.
Oh, yeah.
So it basically, you have supposedly the HGH of, all right, I'm in my 50s, it's supposed to be in my 30s.
All right.
I gained 20 years, supposedly.
How do you record that? How do they measure that?
They did a study. I read it online through, what was it?
Bill Jar saying going off topic here.
Yeah, you're right. I'm sorry, Vildra.
We're going to get to the market here. So,
Yeah, let's get back to making money.
all right. So let's go through some of the things. Let me start things off here by saying, hey, welcome everyone. Thanks, Rob, for spending some time. Anthony, thanks for coming down. Rob prepared some things. So you're going to Skype. I'm going to share my. Should I share my screen with you, Rob? At a certain point, that way I see your images.
The problem is I'm on my phone on Skype.
Oh, okay.
So I'm just gonna have to send screenshots that you could. I'll post them in the chat room, and
All
you can
right.
also show them on the screen for those
Oh,
people who
perfect.
are on the outside looking in who don't have the ability to
Yeah.
enter the chat room,
Yeah, you got
which
to be.
should be a reason enough to join.
Yeah, because this is going to be great here. I'm actually looking forward to the thing. I put out a nice little blast out there, so we should have a nice following tonight. So we're going to focus on options. I want to tell you, I'm not an option expert. Anthony knows more about options than me. Rob probably knows more about options than both of us combined.
Yes.
So I will, definitely direct the questions to these two. I like trading options on the bigger stocks and using options on the HPS. And I figured we'll talk about that a little and get to the basics, because there's a lot of people out there that don't know the basics of options. And going into the option spreads
Order filled.
and going into everything else, I mean, that's advanced material when you don't have the basics. That's jumping a couple things. So we should start off with that a little, Rob, right? Just to kind of lay down the groundwork on
Sure.
options.
So, yeah. So, I guess basically the easiest thing to do, because we're talking about.
I'll bring up some screenshots too.
Yeah, yeah. So,
I can bring up some
it,
on my.
we always have a very hard time doing an option show, because you can't really devote one show to everything that encompasses options. There's so many different facets to it. There's so many terms. There's so many factors to look at. Simply, there's calls and there's puts with options. If you're buying a call, you have the right to buy a security at a predetermined price. If you're selling a call, you have an obligation to deliver the security at that price of that strike price. You buy a put, you have the right to sell a security to somebody at a predetermined price up until a certain amount of time. And selling a put, you have the obligation to buy the security at a price. So think about that. If you're buying calls, you have the right. If you're selling calls, you're obligated. When you're selling options, you're obligated to do something, and it's whatever you're selling the right to. So if you're bullish, you'd buy stock, you would buy calls, you would sell puts, and you would sell put spreads. Selling puts and selling put spreads are considered bullish strategies, which we'll go into how I use those. If you're bearish, you can short stock, you can buy puts, you could sell calls, or you could sell call spreads. Same thing, selling calls and selling call spreads are bearish strategies.
Some of the basics on, and I want to ask you guys some questions, because I know, usually I could actually figure out some good questions and field some questions from the room. So if you're in the chat room, you want to ask these guys any questions, post them in the room. Put a DTRS marker on there. So put DTRS and then your question. That'll give you a little star in the room, and that way I'll be
Tradometer and Q oversold.
Someone asked me to turn down the bot. I can't really turn down the bot unless I turn off the bot. I can turn off the bots though if you want me to. But it's not that, it's not that bad, is it? All right, so so I see there's a lot of comments in the room, but if you have a question, make sure you put DTRS first so we could know that's a question. And put a question mark too, and who you're directing it to also, please. All right, so go ahead, Rob. So I put on a screenshot talking about buying calls, buying puts, selling puts. You would think the most basic example of getting involved with options would be your standard buying a call and buying a put.
Correct.
All right, so that's ground A. That's 101. Buying calls and buying puts. That's what we do.
That's all I do.
That's what Anthony does. That's what I do. When we buy calls, that we're basically trading the setups we have and finding an option that gives us the leverage, but we don't have to pay the price. But we still need to have that stock go in the direction that we plan. So if we wanted to go down, we buy a put. If we wanted to go up, we buy a call. And it's basic like that, depending on... Anthony, do you have any criteria that determines, and this is something I want to get across because I think this is a big question to a lot of people. If they see, like, say Roku is selling off today, when we got into Roku, we got into Roku. We're a little probably underwater. For Roku, for an example, I want to bring that an example. Sorry. And this is basic. We're going to get more advanced stuff in a few minutes. But if you want to say, all right, I want to buy a position in Roku, instead of buying the stock at $127 a share, which could add up if you're buying 100 shares, right? You're paying $12,000.
Yes.
He'll control 100 shares.
100.
You could buy the options instead. Now, the options, let's just start off with that. Let's start off.
Well,
what was the first step on determining what you're going to do with a trade like Roku?
Well, instead of Roku, why don't we use the SPY play that I called in on after the Fed
All right.
spoke?
Great example.
I use your charts. I use your stochastics and everything. And what wound up happening was I had called in before the Fed, and I had said I was buying the VXX calls thinking it was going to spike up and make some money. Well, the VIX calls started spiking up, but then it started reversing. So I got out of that real quick, and then we put in a bottom, which was pretty much on your screen.
Right here.
And once the bottom went in, it bounced. So what I did was I wound up buying those 299s for next Friday, which was the 27th.
You called right around 2:45, right? You did. Actually, it was right around here. You called.
So it worked out. It worked out real nice, and I paid 188 for them.
So what does that represent, just for the newbies?
I did 10 contracts. So for $1,880, I controlled 1,000 shares of stock.
Yeah.
So what wound up happening was, as it was going up.
I want to back it up a little.
Go ahead.
Just to make it easier for people to understand. One contract controls 100 shares.
100 shares. I had 10 contracts.
If the contract is, if you're paying $1 for a contract, you have to multiply that times 100.
Correct.
So that's how he's getting to that price. So $1 contract.
Well, we paid 188 per contract, which was $188.
Yes.
I had 10 contracts. It was $1,880
that's where we're
plus
go.
Commissions.
Yes.
So what wound up happening was it bounced. I went out a week. So at the time it was 298, and the 298 was holding on the SPY. And the more you listen to Powell, he was really appeasing the market. And he mentioned it on a number of occasions. We're going to do everything to help the market. He wasn't going to hurt the market. So with that, I was confident about getting into that play. And as it started running up, we had that 2050 cross, which I always swear by.
Right here.
Which you could see, which was basically above support too. We had that 2050 cross, and then it started going. And once it broke the pivot line, then it went through the 200-day moving average. Then it went through VWAP. Then it was just fuel to the fire.
So Anthony came in today, and he didn't. I guess you took off, right? You got your profit. What time did you take your profit?
I called in like 10 minutes before the close.
But when did you take your profit? 10 minutes before the close?
15? No, actually, maybe 15, 20 minutes before the close.
All right, but you said that you didn't get the full amount. Like,
no,
my God.
not at all.
No,
I was thrilled at what I got, and I didn't want to be greedy because I looked at my watch list, and it showed a 55% profit on when I bought. So by the time I got out after commissions, it was 54.8%. But I'm like, normally when we trade, we always say, listen, if we can make 20, 30% on a trade, take the money, be happy, and look for another trade.
I want to ask Rob about that. I never discussed that with Rob.
Yeah, he does the spreads, which I always wanted to learn.
Do you do all spreads now because you feel like that is your best?
No.
You would trade basic option trades like buying calls and buying puts.
Anthony had a great call on the spiders.
Yeah.
I would normally, I would probably just buy the futures at that point for that rip. But would I buy calls on the spiders? Yeah. I don't normally sell puts or sell put spreads on the spiders, which I guess I probably should.
Explain, and again, I apologize if I'm breaking this down too much, but explain selling puts. What some of the terminology, because that is over people's heads.
All right, so this is probably the easiest way to explain it. So I do what they call selling premium. This is a strategy that I found in almost every case works. It works better when there's higher volatility. It allows me to trade higher price stocks with protection, which we'll go into. But I find it to be like during the bull run of the last two bull runs we had, the best strategy for profiting in a bull market is selling puts. Now people get scared because they think
Explain
naked
what
put.
that is.
Okay, so
break it down.
when you sell a put,
All right.
so let's say Amazon closed at $1,817 today.
All right.
Let's say I sell a put at 1,800, 17 points basically out of the money. Okay, if Amazon's trading at 1817, if you sell an 1,800 put, that's 17 points out of the money. The long holder of that put isn't going to exercise it if it's 17 points out of the money. Do you agree?
Yeah. So when you
until it gets to 1,800, that put buyer does not care. He's losing money. Okay? So if I sell an 1,800 put, I am obligated to buy that stock at $1,800 per share if it should close below 1,800 at expiration. Okay?
All right.
Does that make sense?
Yeah.
So the buyer of that put doesn't have to do anything with it. He laid his bet. He laid money out ahead of time and said, I'm betting that Amazon is going to drop below $1,800. I will gladly take that bet because of something called time decay. So let me ask you, John.
Yeah.
You're trying to be a pretty healthy guy, right?
Yeah, absolutely.
You buy fruit?
Yeah, absolutely.
Okay, so you buy fruit, you have what, maybe 5 days or less to eat that fruit before it rots, right?
Yep.
Sometimes it's a day, sometimes it's 2 days, sometimes it's 3 days. Well, think of me as the man at the fruit stand. I'm selling you this fruit that you're salivating over, correct?
Yeah.
I'm dying to sell this fruit, right? You know why?
Because it's going to rot and you don't want to be stuck with it.
It's going to rot. I know you're going to be back to buy more soon.
Yeah.
But let me ask you, what do you do when the fruit starts to rot?
You throw it out.
You eat it or you throw it out?
Yeah,
right?
you eat it.
It's
Oh, well, yeah. If
worthless.
it's starting to rot, you got to eat it first.
Okay. Well, let me ask you. If you bring those brown bananas back to me, does it make sense
No.
for me to buy that fruit back?
No,
from
you're
you?
not going to buy it back. No.
No way. So when you hear the term selling premium, equate it to the fruit man selling rotting fruit.
Okay.
So let's talk about that as it equates to the reason for the show. So beautiful thing we know about the market is it's two-sided. We're traders. We can analyze the conditions, spot opportunities, and we can also determine the appropriate strategies for our trades, right?
Yeah.
So we perceive prices to be low. We could choose to buy. If we think prices are too high, we can decide to sell. It's no different with options. We have the ability to take either side of the trade, right?
Yep.
But based on the characteristics of options, there's an edge in selling options, or it's commonly referred to as selling premium. And probably the two main points behind the logic of selling options as opposed to buying them is there's limited profitability to improve probability, which I'll explain, and taking advantage of what we call time decay.
Yeah.
So just so
Time
you know,
decay, you know, and you mentioned this, and again, I'm going to try to make it in case someone doesn't know what the hell you're talking about. Like, what the hell is time decay? You know,
I'm gonna show you a picture of it.
All right, good.
But I'm gonna hopefully be able to change your mind about selling premium as opposed to buying premium. Overall, the market goes up about 53% of the time. Yet You can sell options that expire worthless 85 to 95% of the time.
85 to 90% of the time you can sell these?
With less risk and volatility when compared to buying stocks
And-
or buying
Yeah,
options.
you know, before you started this show, I did my research. I said, let me catch up. Let me get some images ready for him. Maybe I could throw some images onto the room and stuff. And what I've noticed on some of my searches is that exactly what you said, the high percentage of success that people come across when they sell puts and they what do you call it with the premium? They what you just mentioned before. That was a word. Maybe it was just whatever it is.
Selling premium?
Selling premium. Yeah.
Yeah. So
80% of options expire worthless, right?
well, that's the number that they say, but what I'm saying is, where is that one figure I have? I was writing it down. Shit.
We have a couple questions, so I wanted to run it. Do you ever consider taking, when you do look at these things, we're going to get into like how do you pick the contract? You consider delta, open interest, volume.
Right. We're going to
go into
get
that.
into all of that. That's even
A little bit more.
that's going to be deep, but
All right.
the typical trade I put on has a probability of profit upwards of 70% or better. And normally I'll close that transaction way before expiration because I've taken the meat of the move out of it. You know what I mean?
Yeah.
The typical probability of profit for the average option buyer is really only around 30%. I would hardly call that a success. So,
All right.
the only way the typical option buyer can win is when underlying stock moves significantly in that direction that you're looking for.
Yeah.
So
Absolutely.
I would rather sell something because of this.
It seems like it's like the hidden thing that's not talked about. Like, all right, market goes down much faster than it goes up. That type of thing. Selling premium is definitely the way to go, but it's too, it's just outside people's knowledge base.
Sure.
Yeah.
So
you think it's a hidden gem?
yes.
You do. If I could say that. I mean, I don't want to sound like a novice either because I never really do this. So I don't deal with it. I like, straight up. I've always been a straight up trader. I've never really been exposed to selling premium. But if someone could put me on a track that says you're going to get believe me, if I see something that works, I'm going to grab on to
There
it.
you go. You want a piece.
Yeah, I want a piece of the action. So
No, think about that again.
Yeah.
Overall, the market goes up about 53% of the time.
Yeah.
Yet you can sell options that expire worthless 85, 90, 95% of the time with less risk and volatility when compared to buying those stocks or buying those calls. So, let's dig a
Quick
little
question,
deeper.
Rob.
here.
When you do that, do you look at where the delta is? Do you look for a low delta with a high volatility? Or you don't look
I
at
actually
delta?
look at the other side of the delta, which will give me the probability of it expiring out of the money. So let's show this example, Johnny, and then we'll we can go back into this. Hold on. Okay, so I have it all on the screen. I'm going to try to encompass as much of this picture as possible. But this is a daily chart of Amazon. This was a trade that I put on last night for the purpose of this show. And unfortunately, I closed it out for a profit significantly because the market rallied so hard off the bottom today.
You're going to post that in the room? And I'll post it on the screen? All right.
Yeah, so here.
Bojangles is asking, Rob, have you ever been assigned on an option? You obligated?
Yes. And I will. All right, so let me just put this disclaimer out there. John, you can post this link that I'm putting in there.
Yeah, I'm ready.
Disclaimer. I am not an options expert. I use this strategy often. I've been using it a lot more lately. I've been getting a lot more complex with it and a lot more active. This is not the only way to make money trading options. There's lots of ways to make money trading options. I'm just taking advantage of what I know about the option market, which I'm going to share with you.
Drink. You want anything?
No, I'm good. Thank you.
I have a Coke, a regular Coke.
No. For now, I'm good, John.
I'll help you out.
Yeah, no. Thank you. No, I'm looking at your charts, Rob. So you're going off the top of where basically it peaked. You look for where if you're selling, you're looking for a green to red candle to start selling your premiums, correct?
Well, so this is the deal. So right there you can see, so yesterday you had that kind of inside bar. Right?
Okay.
One the previous one from today. And I was trying to show you, so if you don't think with 3 days to go that Amazon is going
Tradeometer
to drop to
overbought.
$1,760 or 57 points out of the money.
All right. So you go that
You
far
can
out of the money?
Yeah. And I'll tell you why. Because when I put this trade on, the bottom one, the chance of this thing expiring out of the money was already at 94%, Anthony.
And that's before it rolled over.
Going into the trade. Right? So with 3 days to go, I had a 94% chance that this thing was not going to drop
Tradeometer YM
$57.
overbought.
Okay.
Okay? So I looked at the other side of that as well, figuring, all right, that recent little pop-up, I don't think this thing goes above $1,860.
All right. Based on
So-
what I'm looking at, you have the tail and it just slightly broke above the 1850, and then you had the second candle. So that's where you
Correct.
came up with that idea?
Yeah.
Okay.
And I was also doing this because I've been doing really well in Amazon, and the premiums are pretty fat. I don't know why, but for me, they're significant enough to play in this thing. And I mean, I'm selling out of the money puts sometimes 100 points away, and I'm still collecting nice premiums. And I'm seeing that they're eroding pretty quickly, which I could show John the time decay chart when he comes back. But so let's
Actually,
say
if you have
were-
it, put it up and I'll click it on the screen, the time to gate
Okay.
chart. But just to let you know,
All right.
it's funny you mentioned that because I've been trading Amazon now on a regular basis, and going off the 5 minute, if it gaps up, you get that red to green candle, and then it just rolls over and drops, and those puts really, I mean, you collect some nice premium quick.
Okay, so in this example though, for example, if you don't think Amazon is going to drop 57 points by Friday, you could have sold a 1,760 put. Now, I had to do it as a spread, and I'll tell you why. So, if you wanted to buy 1,000 shares of Amazon stock, how much would that cost you?
You're at 1.8, 5, whatever
Okay.
it was at.
Okay, so unless you have $1.8 million in your account, or actually you would need half of that. You'd need almost $1 million, right? 900,000 and change. You would have to, you would be obligated by selling that put by itself, that 1,760 put. You would be obligated to buy Amazon at 1,760, 1,000 shares. So 1.76 million, and you'd have to put up half of that for the margin.
Okay.
So how do I get around controlling 1,000 shares of stock in a smaller account where I don't have nearly that kind of capital? I can do that by putting on a spread. So I sell a 1,760 put. I collect a premium for that. But then what I do is I buy a further out of the money put to protect myself. So in essence, what I've did is I've created a 30-point cushion.
Okay.
My maximum loss will occur below that 1740 level. Or I'm sorry, at that 1740 level, that's where my maximum loss will be. Because once it drops below 1740, I'm making money on those long puts.
So basically, you're selling
I've
the
lost
puts,
all of
thinking the
money all
market.
the way down, but now I'm starting to make money on the puts. But the most you can ever lose on a spread the most you can ever lose on a spread is the difference between the strikes.
All right, Rob. So you're selling the puts when the market, you're looking for the market to go higher, correct?
Correct.
Okay.
Selling puts, selling put spreads, selling naked puts. When you're selling, you're obligated, but selling puts, you are bullish.
Quick question. Today, did you sell calls when it rolled over this morning?
I did not.
Okay.
I
got to look
closed
into
this
that
position
tomorrow.
out at the end of the day, because I'd already made a good chunk out of it. So let me give you the example.
Go ahead.
I'll get to your question in a second, Magoo.
Punch up the example so Johnny can put it on in the room.
Magoo has a question. He says, I was taught to do credit spreads 80% out of the OTM and or delta of 10%. I would like to know Rob's strategy as far as where he picks to sell and buy the options for a spread. Does Rob do calculations for annualized
Tradometer and
returns
Q over bot.
on risk capital for his spread trades?
I do. I always, that's the whole point to this, is figuring out the probability of success. So just as an example, so I was bullish on Amazon. I sold a 1760 put. I'm expecting this stock to go up. When I put this trade on, when I put this spread trade on, it already had a 93.68% or 94% percentage of it closing, expiring out of the money, and me collecting the full premium.
Wow.
So on this same put spread, you said, well, Rob, you sold the put spread because you were bullish. Why the hell didn't you just buy calls? I'll tell you why. I looked at the scenario, and Amazon was at $1,821 at the time. The 1820 calls, which were $1 in the money, they cost $14.50 each.
Yeah.
So I would have to lay out $14,500 for those options, whereas I collected $560 on my puts. Now you say, well, Rob, you only made $560, but
How much was the total trade that you had to put into? I mean, what was the
Capital outlet.
capital
Outlay.
outlay?
in this case it was 30. Well, I'm sorry, because it was spread, I had a 20,000. Yeah, I had a 20,000 at risk for a small amount of time. But my point to this is, why sell a put spread instead of just buying calls if you're bullish?
Yeah.
Well, I collected money when I sold that put spread. I took in a credit. If I buy those calls, I have to lay that money out of my pocket. And those 1820 calls, they only had a 53% chance of making money.
How about, or buy a from Skull Body, buy a call spread, also a collar?
That's going to get into that's going to get way too advanced for us right here.
And with these type of trades, what type of commissions are these things?
I mean, you can go to discount brokers.
Yeah.
You can go to
They're normal.
They're not much.
Yeah.
Actually, Robinhood does it also.
Right. So now you have the contra. Look at the above trade. So these are two separate legs, which coincidentally I put on for the purpose of this for the purpose of this show, but also I saw the opportunity because when I sold that call spread, at the time it had an 87% chance, almost 88% chance of expiring out of the money, which would have gave me my full profit. So with this two-legged trade, if you're just looking at the bottom one, as long as it closes above the green line by expiration, the bottom green line by expiration, you make money. If it closes below, you're going to lose money, but if you have a spread, you're protected.
I would like to
Most
be able to
traders
give
get
you
it.
I would like to give you a chart, and you do it, set up a trade like something that has pulled back, and we expect it to bounce.
You know what? I got an idea.
Or what?
Rob, are you by your computer where you could pull up one of your charts for the options? Because John could pull it up and we could show the example about doing a spread and how much money it would cost. Because if you're buying a put and selling a put, you don't have to actually have the 20,000 available. You're capping your loss at a certain dollar amount, correct?
Correct. So by doing it as a spread, I have to put up a lot less margin to put those position on, and I can control the same, if not a lot more stock, because I'm protected. If you try to sell a naked put in Amazon, it's 1,800 points before it goes to zero. But
Yeah.
if you sell a put spread, the most you're going to lose is 20 points.
Yeah.
So you can buy significantly more leverage.
All right, but I'm liking that chart you put up on the screen, especially if it holds above a certain level. Like I know a couple of good stocks down here that I would expect to hold and start moving up. If that was something, I say you were on top of a stock so much that you pretty much could guarantee a move up, and you wanted to get in. How would you do that? Would you go straight in with the just calls, buying the stock, or one of these?
You can actually use.
I mean, there's different factors involved. It's the price of the stock. How is the options market? Is it?
But I'm saying
is
but I'm
it
trying.
liquid?
I'm trying to kind of grasp where I should look at if I have a very good opportunity. Say this stock right here, Eli Lilly is on the screen. Let me bring it up on the screen here.
Yeah, I mean, I'm looking at Johnny's trend line.
Say-
It's constantly going in a downward trend. So at that point, you would just sell like a call spread, right, Rob?
Yeah, call spread.
Okay.
If you think it's going lower, you might want to sell like a 120, 130 call spread. If you think it's going lower, if you think it's higher, I don't know, maybe sell a 190 put spread.
All right. Well, let's.
Which way do you think it's going?
Well, let's say this. I want to get
I see
the.
a
I like.
weekly buy divergence.
Yeah, I'm not worried about it now. But let's say we were here, and I said, Rob, we have a reversal candle. I'm going back. I don't know if you can see the screen. We have a reversal candle. We have the lower trend line. I want to go long. What technique would you trade if I gave you a percentage saying, all right, this is a perfect HPS setup. It's close stochastic, which it was. It was a lower trend line. It was a reversal candle. This is my perfect setup. If you have a perfect setup, it gives you such a high probability of success. What approach do you take to it? Do you take one of your approaches, or do you go straight in? What gives you the best return?
Sometimes I will strictly go on the probability of success, but if you tell me there's a HPS setup involved in it, or there's an insider purchase,
Yeah.
I would be a lot more inclined to maybe sell a strike price. I would sell puts.
So tell me how you would
Because I
set
know
this up. So this is trading at about $110, $109 at this point. We're looking at it. It just closed under $110, but we want to go long here, and you want to do a spread. What type of spread? Just so I get a live, like a real-time example, and I could I just need that for my own mind, because my mind doesn't work sometimes, unless
Okay. So let's say you think in the next 9 days, by next Friday,
Yeah.
you think it's gonna
be up.
it's gonna be higher.
Yeah.
Okay, so it's currently trading at 113 right now.
Well, no, it's trade. I'm just saying whatever it is at this point in the chart. Pretend it's at this point in the chart at 108, 107.
Lily? I'm showing 112.72.
I know, but I'm saying I went back in time. I went in the hot tub
okay.
time machine.
Sorry.
I'm just saying this is a setup I would like to trade. I'm not going to take it now because I don't have an edge. But if I had that everything set up for me,
The
and
candle before the 112, Rob, when it was down
this candle right
on
here,
the daily.
Yeah, what was the low on that?
that was 105, and
Okay.
it closed like at 108.
Okay, so
And eventually
I'm
moved.
still
Well,
gonna-
actually, eventually moved higher over time. Well, you know what? That's going out too far.
just look at it today, John. Go
All
to
right.
the
All right.
just so it's realistic.
Yeah. All right. Fine.
We don't play.
I actually like this one going into tomorrow. So, or going in. Yeah, I think we move up on this. So, all right. So
Okay. So what's the lowest you think this thing is gonna go tomorrow? You think it's just gonna gap
tomorrow?
and go at the open, maybe?
Yeah, I think the lowest it'll go is 111, 112.
Okay. So if you really have this much conviction with this thing,
Just say.
you
I'm
might
just-
want
I'm
to
just-
sell. So what I would do is I would try to do it because I know expiration is so close.
Yeah.
If you think this thing is making a move tomorrow, you can sell a 112 put for 47 cents.
All right.
Okay. If this thing closes above 112, you will make money.
So if I
Because
sold
there's still
a
a few
112
days of
put,
expiration.
all right. So that would be. You go in there and you sell the puts, and you could do, say we do 10 of them.
Okay. But the problem is if you do 10, you're going to have to come up with $112,000.
Oh, see.
No, I'm sorry. Yeah, sorry. You're going to have to come up with half of
Forget that. Forget
$112,000.
56.
Okay, so now what you have to do then is you have to spread it. So you sell the 112 and you collect 47 cents.
Uh-huh.
And you might buy the the 106 that's trading at 12 cents.
Yeah.
Okay, so net you have
30.
a credit of 35 cents.
Yeah, 35 cents. All right.
So if you do that on 10 contracts, if this thing closes above 112
Mm-hmm.
by Friday, you're going to collect $350.
All right. And how much do I have to put up for that? You said.
Well, in this case, it would be 112 minus 106. That's 6 points. It would be $6,000.
All right.
Now, granted, let's say you wanted to buy those 112 calls expiring in 2 days. They have only a 60. So the at-the-money calls right now only have a 61% chance of being profitable. Right now, you'd be selling the 112s, and you'd have about the same because it's at the money. You would have about the same chances.
All right. So selling puts or selling, I mean, what do you think? What were we talking about? Selling.
They were doing credit spreads. Rob
Yeah.
was doing credit spreads, but I don't know who's up there. They're just going naked selling the puts or the calls, which is good as long as you're making money. But
Listen.
if the thing reverses on you, you're stuck.
See, time decay favors. John, can you show this thing?
Sure, we could show anything. I'll put it over
Show
here.
this time decay chart. And this will hopefully.
I want to bring it up on the screen in a second here. Listen to Day Trading Radio. Welcome, everyone. You got Rob here doing a special segment on trading spreads for income. And we'll get into that word income. I'm curious about that income. It makes it sound like this is a job, and you're doing this on a consistent basis to make a living. Is there a way of setting up things like that, where you could, attempt to apply this just on a non-emotional thing that you just have to take certain trades, or that you have to apply this to something?
Well,
What's the definition? Why income? Why not money?
Well, you're
Well,
doing it on a recurring basis.
Is it because of the
Yeah, I
recurring
mean,
basis?
It's me selling rotting fruit to you every.
Am I
every week.
collecting this each day?
Rob's basically the drug
Yes.
dealer.
I am
and
collecting.
selling
So
the drugs.
That's another good question I have. I mean, each day that this continues, I'm collecting that premium and it gets put into my account.
John, show my chart.
All right, I'm going to do that right now. All right, there it is.
Okay, so you can see 90 days out. Look at how much time is involved in this. Hold on. I'm moving stuff around. Where is it? Okay.
And again, if you have a question in the room, please put the DTRS space, and then your question, and that will give us a good indication that's the questions, because we got one here from Zouch here. How many days out from expiration would be good to apply these spreads as short-term trades? So if we had if you want to consider this as short-term trading, we want to take this as many times as we can. We want to be able to get our money in and out as fast as we can. What would be the shortest time frame we could do these? I mean, we could do them in a day, right? Like on a Friday options expiration type of thing.
I almost got burned on options expiration trying to do a put spread with 2 minutes to go. So I look at all times of the day. Like I said, I'm selling rotting fruit. I don't know which time frame. I don't know how quickly it's going to rot.
Someone might step up and want just a smoothie and don't care if it's rotten. Take you out of your trade.
Well, maybe I'll lose on that smoothie in the next day, but the odds are stacked against the option buyers.
I want to throw some terms. I know I'm off topic here, but I see a lot of people throwing in straddles, collars.
What you're looking at on this, what you looked at before on the screen, my Amazon trade.
Yeah.
I didn't intend for it to start that way. It was just going to be a one-legged trade, or one-sided trade.
Yeah.
It started out as a put spread, but then when I saw that I was making money on the put spread, and I thought Amazon had no shot of going higher for the time being, I put on a call spread. I sold a call spread. But that together, a call spread and a put spread, that's considered an iron condor.
That's what an iron condor is.
I did not intend to do this, though. But that's the beauty of options. My one-sided trade, I was able to press my bet, knowing that I was making money on the downside. And that's another way. If you start losing on one side of the trade, you can open up the other side of the trade that you know you're going to make money on. You're going to make money on one side, correct?
Yeah. Yep. So once you start to break out, I see what you're saying. Go ahead.
In this case, I made money on both sides.
Rob,
I only left it open one day, but
there's a couple of stocks you got to look into because they're big dollars. I don't know if you're trading it. AutoZone, AZO.
Oh yeah, I saw Max in that.
And
today.
then Booking. Those stocks move on a regular basis. You can pick up some really nice money off them.
Yeah, AutoZone is nice.
Well, AutoZone runs up and then it falls down. It's like Booking. Booking, Ubi got me into that. What was that? 9 years ago.
Ubi was all into Priceline.
Yeah. Well, now it's Booking.
Yeah. What is BKNG?
Yeah. That I got to tell you, still to this day.
$2,000.
I know. We were trading. It wasn't even. It was like $500-600.
Holy crap! We were trading it back
Actually,
here.
it was a couple of $100. That we're going back.
Yeah.
You got to go back 6-7 years ago.
I mean, look at this chart. That is amazing. I mean, I remember you guys traded That's when people made a lot of money, but that's also when people got busted.
Oh,
they crushed
Friday,
people too.
When I was in
it was
Florida,
it was feast or famine with that
It was
stuff.
the greatest time in the world because I would trade Friday morning.
Yeah, I remember that.
I would make like $1,000-1,500 off it.
Yeah.
I go, give me like 30 minutes. I got to jump in the car, and I would drive to the East Coast, and he'd break my chops. I just made an extra $4,000 because but every once in a while it would go the other way. But he was making a killing on that stock every Friday. And for 2 hours and 20 minutes, I got called every name under the book because he was making a killing. And all I ever said was, I go, you know what? I made a quick $1,500 and I'm in the car driving.
$1,500 is great, though.
I know. But you know what? It's
yeah,
all off
raindrops.
the
I got it
percentages.
recorded. I'll send that to you.
But
Or
that's,
send it to the
that's
members.
why on my watch list, anytime I have a trade,
Yeah.
I put in percentages, day percentage
Yeah.
and overall percentage. Because once I see it gets starting to get over 10, 15, once it gets to 20%,
God.
I keep a tight spread on it. But today, that one SPY call trade, I had 10 contracts. Like I said, after commissions, it was almost 55%.
Yeah.
And I'll look into it tonight on when I bought it and when I sold it exactly. Maybe I was in it for 30 minutes. I don't think I was, but call it 30 minutes. It was just a nice hit.
Yeah.
And I had the 299s and I did the 300s.
Yeah.
I
You know what?
told
I
you
thought about right when you called. I was just doing so much, and I was juggling stuff. I was getting into the Roku. I said,
Well,
I like that call though.
Yeah.
I liked it. I said
Well,
maybe I should get into it. I lost track of the trade, and I didn't get into it. I'm kicking myself afterward. I said, holy crap! Look at that
I
thing.
was listening to you talk and said, look, this is a bottom here. And you started talking about trend lines and stuff. And then I looked at your charts, and then all of a sudden my VXX calls started deteriorating.
What was right here? We pointed this out in the
Now,
tradeometer.
if you look at that, okay, you see that right there?
Yeah, let me-
punch up the TLT and then the NUGT, the gold, and you'll see right at that point everything that was pretty much the bottom. Gold, oil, and the VIX was at the high. It just dropped. So when all that dropped, I knew that was going to go up, and that's what made me start getting into the SPYs. If you look at that time frame, if you punch up the gold,
All right.
the gold and VIX indexes, they were at the highs at that point, and then everything rolled over.
All right. I'm gonna look at it here. 5 minutes. I'm sure it was. I mean, well.
I had the NUGT up, which is the same thing.
Oh, the nugget. All right.
The nugget.
Yeah. Well, this was a nice bounce right before. Yeah. I mean,
Yeah,
they
but
all.
are you on the 5 minute or are you on?
That's the 5 minute right
Okay,
there.
and if you watch, you'll see it started selling off right around 2 o'clock, right when Powell spoke. If you noticed, it came down. Then right around 2:30, it peaked. It made like a little bit of a dead cat bounce on the gold, and then it dropped. As it was dropping, that's when I started to get into the SPYs.
Yeah. It was good. That was a great call. I didn't follow it though, which I'm now regretting.
Well, at the time you got back, you were looking at, you
Yeah.
had all. You
But it
know,
was
always-
good. I felt good about it too. I didn't even think about taking it out, honestly.
Well,
I
at
didn't-
that time, you had the tradeometers going all over the place
Yeah.
because it was jumping around and the parameters were getting messed up
I
because
you know,
of the algos all over the place.
That was a great call. I kept on telling you. I shouted you out multiple times. Great call, Anthony.
Now go based on, look at your stochastics. That there was the other thing that gave me the support on it.
Wow, look at this.
because-
Look at this divergence here. Just
Yeah.
a second. Look at that divergence. See that candle right here on live on the screen? It's a great example of that divergence that happened. That spike up to the highs, took out the previous highs right here, and then came down. But look at the stochastics here. I mean, this was a classic sell-side divergence. I didn't see it trigger on the.
You might have had it turned off because we had Rob on.
Yeah, I think I turned off of the triggers and
Now,
stuff.
if you notice, we're getting a 2050 cross going down, so does it push even lower? Right now, it looks like it's holding above the 200, which.
All right, so we're looking
I'm
back
sorry,
at that.
Rob's talking.
No,
I got
but we're looking
sidetracked.
back at the. No, he's not talking. But we wanted to look back at his chart because I wanted to get more of a better example of the decay. This is a great example. This is a standard across the board example of time decay.
Correct.
And how it works. Fastest
So
time
you can
decay
see,
is about
obviously-
how. What is that? What is that? What? How many days is that fastest time decay?
Well, it goes from 90 to 60 to 30, and in the last 30 days, do the math, that's probably about the last week
The last week. All right.
right there. So I often say in the chat room, you know, it used to be when when weekly options first came out, the shrewd guys, they would sell puts on Friday. Come Monday, they got 2 days decay.
Yeah.
And Monday morning when it opened, they're already in the money.
It
So
almost
the
seems like
market makers-
yeah. It almost seems like it's almost one of those things where things rebalance, and They priced lower, right?
Right. So what happened was the option market makers realized that they were getting screwed. So now they've adjusted their option pricing on Mondays and Fridays. So I rarely, if I'm going to sell puts to try to collect some premium and get that decay that you see occurs in the last week, think of that if that circle encompasses 1 week's time. Look at how steep it drops off on what would be the last day.
Oh, yeah.
I'll tell you what, come 11 o'clock Friday morning, those options, they really have zero friggin' chance of expiring in the money.
Unless, do you find that they just, if they're in the money, right on in the money, are they trading on a like a one-on-one basis, like $1? Is that
well, here? Let me show you this picture.
All right, that's a good question. Thanks, Johnny.
This is
Let's take a bite here.
Oh, here it is. Yeah. Show this one, Johnny.
Right now, you're still holding on that 200.
Order submitted. 1 minute by divergence.
Guys, I'm posting this in the room. This
Order
will give
filled.
you
Order
a
submitted.
idea
Order
of the
submitted.
value of at the
Order
money
submitted.
versus in the money versus out of the money. And this is what the decay looks like for each one of those classifications. Johnny, if you want to put this
All right,
on
I
the
want to
screen.
put that in there. Right when I get that link. All right, here we got the link. Let me get it on the screen. That was the rock bot here taking a trade. Anthony just pointed out the 200 period moving average. Look at that big pop here. I want to bring that rock bot up on the screen just after a second here. Rock bot exclusive for Day Trading Radio members.
When you look at Johnny's chart, you're going to see it bounced off the 200-day
Yeah, let me
moving
show you.
average three or four times on the 1 minute chart, and then it just popped up, and now it's right above right above middle VWAP now.
Yeah, look at that thing popping, and we're going to go over to the bot channel fast just to take a look at that.
And then your stochastics on your 9-3 is showing a pop up, and now your 14-3 turned around also.
Interesting. And back here was a sell divergence.
Yep.
So you have a sell divergence, big move down, buy divergence, big move up. Back to the chart here. Go ahead, Rob.
No, so you can see in this case, time decay
Order
favors
filled.
the option seller, not the buyer. Options are a decaying asset. Why would you not want to sell rotting fruit to the public? They decay with the passage of time. Options. They expire. They expire every Friday. Technically it's Saturday, but they stop trading Friday.
Oh, I see. At the
So-
money, in the money. They still expire.
Yeah. So even if other factors that affect an option's price, such as the price of the stock or the volatility, as long as those remain the same, that option will always be worthless expiration. Why? Because there's no more time. Time is a component of
Asian just opened,
the
right?
option premium.
Yeah, 9 o'clock.
Yeah, Asian shares edge higher after Fed, and that's what gave us the pop in the market here. So it looks like Attila tight stops. Isn't it in your favor if you're a seller?
Yes.
Yes.
That's the whole point of the.
Quick question, Rob. TLT sold off today. TLT should actually start reversing and going higher in the next couple of days because the rate was cut. That was trading around 147 last week. I think it closed at around 140 or 141, the TLT.
Yeah, I don't screw with bonds.
Okay, never mind.
I just
All right, it went down to 139. All right.
and again, I would probably. Yeah. No. I would
Do you
stay
do
away from
anything
those.
with the like the nugget with the gold or anything, or you don't? You stay away from that also.
No, I mean.
I've been doing the reason why I'm asking. I'm doing well with the buying of the calls and the puts, and I've been using the 5 minute with Johnny's charts. So on the TLT or the NU, the nugget, there's a lot more volatility. Then again, also with Labu, which I was never a big fan of, but once it gets down into $37, $38 range, I just buy calls, and then in a couple of days later, it's in the 40s. And then once it gets up to about $43, maybe 45 if it gets that high, I start buying puts and then it rolls over. I mean, one day it's going to burn me, but it hasn't as of yet.
Yeah, I don't screw with the TLT. I don't really touch the
Labu.
I don't really touch the commodities.
All right.
We got a question in the room here from
Shoot.
Jody. Jody Wody. Hey, Jody. Long time. Hi. Regarding the options, my understanding is that when volatility explodes, selling options is the way to go. Option prices really become overvalued, though implied volatility through implied volatility. When there's a shock to the stock on the downside, like Roku today, so if you sell a put when volatility is high, you have a very high chance of profit. That is because the option is very undervalued. But if you think the stock has bottomed out and buy a call over a something, and I lost the rest of that, Jody. It didn't show up in the chat here.
No, definitely. Volatility definitely favors the option seller. So there's time decay favors the option seller. Volatility favors the option seller. Option sellers don't have to be right in the stock direction, right? You buy a call, you have a 53% chance of being profitable, a long call.
Order
But you have
filled.
to be right
Order
on the
canceled.
direction, pretty much.
Yeah.
And it has to move really in that direction for you to make money, right? Stock price can move in 3 directions, up, down, or sideways. So when you sell options, you can be profitable when the stock moves up if you're short the puts, if it goes sideways, or even it goes slightly up or even slightly down. As long as it stays above that strike that you sell, you can make that work for you. And along the terms of volatility, yeah, option prices are expensive when implied volatility is high.
So Jody said that is because options are very oversold. But if you think the stock has bottomed out and buy a call over a short term, it is still harder to make money buying a call versus the put sale, because not only does time decay lose its value, but also volatility shrinks its value. Yeah.
Correct.
Okay,
No
but
doubt
Jody,
about it.
the way John and me are trading it, not so much Rob because he does the spreads.
Yeah.
We go off basically the high probability setup of the stochastics and the trend line. So when we see a bottom, we have a better than a 50-50 chance of being right. It's more like an 80% chance of being right. And then once we get a 10-15% profit, we make sure we don't give that up. So once it starts stalling, we get out of it quick.
Yeah.
So we're not holding it for a long period of time. That's that old saying where they say, almost 90% of all options go worthless. They don't mean people that trade. They're talking about people that buy and
No, that's
hold.
a good point, because, that's a really good point. I want to go back to that income thing, though. I mean,
Right.
just kind of like holding something over a longer period of time, letting it work for you, knowing that it's probably going to decay if it's not going to move. So what is what is the best and I think Jody just said it. When there's a big pop in the market is the best time when there's a lot of premium in an option, and those options are so expensive, and you look at an option. Sometimes look at an option, I'm like, oh, let me get some out of it. Well, whoa, hold on, I'm not getting in this thing. This doesn't seem right. It seems too expensive. I'm not buying a $13.
Monday when we opened, oil went through the roof. They made all sorts of where they're going to be out of commission for months. And then 2 days later, we'll be online inside of 2 weeks.
But, when you do get those pops, is probably the best time to take those. That's probably the best time to do this strategy, right, Rob?
Yeah, so, I mean, you always hear me talking about mean reversion, right?
Mm-hmm.
Implied volatility really is described as reversion. I mean, I'll tell you why. So option prices are expensive when implied volatility is high. They're cheap when implied volatility is low. It's been found that high implied volatility has a tendency to decrease over time. That's described as reversion to the mean. Same type of thing like I do with a Keltner. The opposite action of low implied volatility increasing over time is harder to predict. We sell options that are expensive or meaning they have high implied volatility, and we buy them back when the implied volatility reverts back to the norm, which tends to naturally do over time anyway. So it makes sense to sell,
What were the
Why would
stats
you wanna
again?
sell
Most
something
options
skyrocketing?
expire. Is it really true that most options expire worthless?
Yeah, because you
And
look
what's
at
the
any-
percentage of that? 80%? Is that really true?
Well, I think they mean in terms. I don't think they mean in terms of the overall market. I think the ones that you play in tend to expire. So when I choose an option strike, I go into it knowing, like I said, you saw on my Amazon examples, one had an 88% chance of being successful in the next 3 days, and the other one had a 94% chance. I'll take a bet that has a 70% chance sometimes less. If you had a rally today and you thought the move was going to be sustained, you might want to take a little more risk and sell something that has less of a probability, but you collect a higher premium. That's the thing. When I tell you about picking up money off the sidewalk, I'll go way out of the money if I could collect $200. And I don't care if it's 100 or 150 points away. I've done it with Amazon, 120 points out of the money. People are like, oh, that's scary. Amazon can move 40 points in one day. Well, rarely does it move down 120 several days in a row. It happens. It happened last week. But, again, if it starts going against you, you can do the other side and make it an iron condor. It's no more risk because you have protection in place.
Yeah.
If you sell puts or sell calls, you always should buy protection.
Is there any certain sector that this works great with? I mean,
No,
like
I just
commodities?
find it works. Well, there's some ones that I like to play in. And that's the other thing, too, is so I do put spreads because there's a smaller margin requirement required to take on the position.
Oh, that's good to know.
Yeah, I think you were running away, John. But so, for example, in this Amazon, somebody asked, why didn't you just buy calls? And I explained because the calls had less of a chance of expiring in the money than the puts had the chance of expiring out of the money.
And
right?
that's usually the case. Unless
Right.
it's really in the money. I mean, but if you're...
Again, just that time decay chart that I showed you, if that doesn't entice you to sell premium, and I'm not encouraging anybody to go do it, but I'm saying if you had the capital and you had the wits and the know-how on how to do this, there's no other logical choice but to sell puts.
Do me a favor, Rob. I know I'm bothering you with this, but I think that the members of some of the beginners would like you when you say, if we have the know-how of doing this. When you want to do one of these trades, can you walk us through what you do?
Sure.
Just kind of like, I don't know.
Did you do one today that you could walk us through it with the commissions and it, with the price points and everything? Or I don't know if you traded today.
I only closed out that position, and like a jackass, I drew the pretty chart for you, and I wrote down the what I collected. But
I could bring up an option chart. I could bring up some option. I could bring up an option thing on this thing, and we could look at the options, and you could just tell me. I just want people to kind of. I just know this is, even though we expect it to be a little bit more we understand some of the terminology and stuff. There's a lot of people out there that might not even like, holy crap, it's still over my head. So if we look at, give me an example of a stock. You want to look at Amazon, AMZN? I could look at that one.
Sure.
All right.
That's easiest.
So Amazon, I want to bring up an option chain on this. And when you do a spread, what do you have to do in your account, basically?
Okay. So, for example, $1,817 is where Amazon is right now. Tomorrow is Thursday.
Oh, these things were down 30% today?
Yeah, there was a big drop today.
Wow. I mean, yeah, look at some of these options. You get 30-40% on some of these things. It's amazing how
If you
much.
looked at the 5-minute chart, how it rolled over at the open, it was unbelievable how picture perfect it was.
Oh yeah.
Look, you perfect example. You had the 2050.
Look at did that jump at the end of the day?
That was when the Fed was speaking. But look at the 2050 cross at the open. The
Yeah.
2050 cross
there.
rolled down and open it up, and you'll see it's just started free falling. It was crazy.
And John, that's the only reason I covered that Amazon was after that rip off the bottom. I didn't want to give back a gap up of 20 points tomorrow morning.
Yeah.
You know what I mean? So close your option position when you can. I usually always close them before expiration. Unless they're so far out of the money, I won't bother because then I just have to pay a commission again.
Yeah.
But actually, at Thinkorswim, if the option closes at less than a nickel, you don't pay that. You don't pay any commission.
Now it says Yabana is saying, "I like Rob strangle." What? Give me the definition of a strangle versus
No, that's not a strangle. That is an iron condor.
or
which
condor
was-
or
which
whatever.
we were
All right,
showing.
the condor. Yeah, we were talking the condor.
Condor is just a put spread and a selling a call spread. Well, a condor is a put spread and a call spread. Spread out.
All right, so we have. Let me get. I want to get a. Give me Rob's. I mean Anthony's here.
Got it. Now, do you do anything, Rob, with calendars, where like you'll sell a call and then buy a next week or a monthly call out?
Sometimes I will buy. This is something I actually have. I was going to do in Beyond, and I snoozed on it, and I lost all of my gains in some long-term dated calls that I have in Beyond. But yeah, sometimes what I'll do is I'll buy longer dated options, Anthony, like maybe 6 months out in Beyond.
Okay.
At a lower strike, and as the stock runs, I'll sell weekly calls every week for those 6 months.
Okay.
And
So you're buying down
you're
buying down your purchase over time.
I'm reducing the cost of my original purchase,
Right.
and I'm
Okay.
also collecting short-term income on the small fluctuations. And again, with this time decay, at the end of a week, even if the option is in the money, there's no time value in that. That's just intrinsic value then.
Right.
Right? So, yeah, I may take a loss by covering that weekly call, but I've made a lot more on those leaps or those 6-month options than I lost covering those calls. So it's a strategy to keep covering calls and writing calls every week against that long position. And that, in essence, is a calendar.
So basically, you're not tying up a lot of money, and you get yourself
not.
a weekly paycheck out of the deal.
Yeah, and there's guys that actually will buy. They'll buy stock, or in place of stock, they will buy leaps, long-term dated options, and they will sell weekly calls every week, and they'll collect 52 paychecks a year, just selling premium.
Got it.
Cactus's father used to do that all the time with big positions, and he would sell calls and he would roll them every week, and he'd make more on he'd make more on his positions, and he would lose. It's constantly ringing the register, just like we do when we sit there every day. You want to pay yourself, and if you can pay yourself 52 times as opposed to 12 times a year, why wouldn't you?
Yep. No, I see what you're saying.
It's selling calls, selling puts. It's all generating premium. Whether you're long the stock and you're selling calls against it, that's collecting premium. If you're selling puts that you don't own or naked puts, that's collecting premium. You're just trying to take advantage of the fact that we know that there's very few guarantees in life. Marriage, well, maybe not marriage, but death, taxes, and premium decay.
You notice how I'm keeping quiet.
Well,
Anthony, were you ever married?
No. That's why I'm still happy.
I didn't know.
Order submitted.
A wise man.
Order filled. Order submitted.
A wise
Order
man
submitted.
posed the question.
Order submitted.
Do you know why a divorce is so expensive?
I remember that saying because it's worth it.
Exactly.
Charlie Sheen had the best line. I never
Oh,
paid
careful.
for sex. I
Careful.
just paid for them to leave. I'm behaving.
Anyway, back to premium.
Back to premium.
Yeah, back to premium.
Uh,
all right. So what do we? All right. So
John,
we're. Go ahead.
So we're talking about Amazon.
Yeah.
What you would want to do, maybe. So, right now, and this is how I decide now.
I got my paper and pencil out.
Okay.
It's gonna be math.
What kind of risk do I want to undertake right now in Amazon? Looking at the chart, it's kind of going sideways. It's right in the middle of the range. I know on average this thing moves, and let's get a current.
It's been holding that 1780 to 1800 level as pretty much as a bottom before it bounces.
And listen to me, news rules all.
Yep.
Yeah.
You get into a position, if the market goes against you because of some news, no heroes.
And
I'm
it's
not saying put on an option position and hope for the best. I put on an option position to start capturing depreciation as quickly as possible. Usually when I get to a 50% profit on the trade, I'll start taking profits. When I get 50% on the options that I've sold, they've decayed 50%, I will start covering.
When do you use a stop loss, Rob, on this stuff? What is it, 10%, 20%, 40%?
Usually in the case of options, I do like a 30%.
Okay.
But I do have protection in place if I'm doing a
Order
put spread.
filled.
That is my protection. That is my ripcord if I'm wrong. But a lot of times I won't let it get to the point where it's starting to lose money. If I'm making money and it starts to lose money, I may close it out for a small loss, or I may let it roll. But I usually start to my intention of selling premium is not to let these things go to expiration.
yeah.
I'm just trying to take advantage of the
bigger move.
most price decay I can,
You're getting
which
the meat.
usually occurs in the last couple of hours or last few hours. So Friday by 11 a.m., if this thing is not going in your direction, get the hell out of those things if there's still even a bid for the options that you want to sell. If you're long calls, for example. I'm telling you, going into a trade and at the money, you buy at the money calls. Going into the trade, you only have a 50% chance, a 53% chance of making money. Actually, I only think it's about 30%. So if you know with some cushion, you could sell some puts that are away from the market that you know it's never going to get near that price. That's the free money on the ground that I'm talking about. You know, I'm not saying you're probably going to make $1,000 where, you know, you guess right with Amazon. You buy it after the Fed, right, John?
Yeah.
After the Fed comments, that thing ripped off the bottom, 15 points? I think it was down
Yeah,
almost
15 points.
30
Yeah,
at
it
one
got
point.
down to
Yeah.
1797. And if you look, you
97
had that
closed at
2050
17.
cross and it just rocketed.
Okay. So 22 points about, right? Or 23, 24. It's ripped off the bottom. If you bought long calls near term, like with expiration in a couple days, you would have made nice money on that. I'm not going to lie. But when the stock was down, if you think it's going to bounce, give yourself some cushion and pick some prices below that you don't think it's going to get to. And then look at what's the percentage chance of that expiring out of the money, which is what you want. You're selling a depreciating asset and hope that it's worthless by the end of the day, or you could buy it back cheaper. So let's look at the example of Amazon. So it's closed at 18.17. So John, you're looking at the chart of Amazon. What do you think the lowest this thing gets to by Friday is?
All right, let's take a look at that. I want to take a look at the daily chart on this. All right, so we're going to look at Amazon here. We have the minute chart up here. I want to go out to the daily. You know what? We're holding the trend line. We want this trend line to hold. I mean, honestly, by Friday is 2 days away, and it closed on the highs here, and the 200 period moving average seems to be high. I say
And
worst
the
case,
market ripped.
and the
at the end
market,
of the day.
yeah, I would say 1792 would be the low of today's candle. I mean, would you use the low of today's candle as a support level? I mean, I think it's going to hold up. I mean, you want to try to keep it as high as possible to get your price down.
Well, you want it to be.
I'm technically speaking,
Amazon to rip.
yeah, I would technically speaking, I would like to see it hold that 1805, 1806 area.
Okay. So if you thought.
Worst case scenario, the
gonna-
200 period moving average. I think if we broke down through that, that would be problematic. But
Okay,
you know,
why don't we say 1800?
all right.
Do you think it's going to go below 1800 by Friday?
You're so close to it, you don't even
No,
know.
it's so tough because we have, personally, I feel like today's market was very bullish for we had good results out of the Fed, and now that we closed on the highs, I would expect this to go higher.
The problem is with Amazon, there's a lot of negative news. Germany's
but-
hitting them with a bunch of things for the couriers.
We have a gap here.
No, I
We have
agree
a-
with you. I really thought today we were going to get above 1830. But then that Germany news came out and it started selling the market. And that was basically at the open. It rolled over and started going down. I don't know if you caught the news or not, Rob, on Amazon.
A move down to below 1800 would still be bullish on the trend.
Okay. So let's analyze this. So you're thinking this thing isn't going to drop $17 by Friday.
I'm not.
That's our premise going into this, okay?
Yeah.
So right now, if like at the close, you could have sold an 1800 put.
All right.
You could have collected $4.25. And right now, mathematically, this thing has a 74%.
So, all right,
chance
let's
that
back
it's
it up
gonna
for the
expire
beginners
worthless.
and myself. So you're
Okay.
saying we're selling a 1800 put?
Yeah. Do you
All right,
have
so I want
the
to go.
chart up?
Yeah, I
you
want
have
to.
the option chain in front of you?
Yeah, I do. I want to bring the puts up here right now. All right, so we'll bring the puts up here. So, but we're talking about the earliest expiration, 2-day expiration.
Correct.
All right, so we're gonna go down to 1800. It's trading at 450.
top
Oh,
one.
actually, 450.
Right, but if you hit that bid,
Yeah,
the
hit the
most
bid.
you're going to get is 425.
Yeah, I'm gonna hit the
Okay.
bid.
Okay, so now you just
So when
sold-
Rob is talking about is selling a put, you're gonna look at the put, but you're actually shorting the put.
Right, you're selling something you don't own.
You're
And
shorting. This is another word for shorting.
in itself, the obligation is if you sell that 1800 put, you are obligated to buy the stock at 1800 if it goes below 1800.
Yeah.
But we're never going to let it get to that point. I reiterate, you are never going to let this thing get to that price if you're selling puts. That's my disclaimer.
All right.
You can lose a lot of money. And in this case, like I said, you're going to have to put up half of $1.8 million to buy it at a price of price at 1800, regardless of where it goes. If it drops to 1700 and you've sold 1800 puts, you're buying it at 1800 and you're already
right,
down
you-
100 points.
All right. But let's talk about realistic. Like, we're setting this trade up for someone who has a smaller account and they want to try to trade this. How would you what would you do? Let's just talk about a couple of things that we could track over the next couple of days. So you're shorting, you're selling the 1800 puts. So say we're going to do, should we make it easy? For argument's sake, we're going to make one. All right? One. We're going to sell one put.
Okay.
All right?
So
Order
your
filled.
cost, even if this thing closes at 1800, in essence, your cost would be $1,795.75. Do
All
you
right.
agree?
No, I don't know. I don't know how you got to that number. Explain it to me.
Okay. Because you just collected $4.25.
All right. Explain. I'm sorry. You know what? Explain this whole
No, it's
process
okay.
to me.
It's okay.
All right. Go ahead.
So,
So I'm subtracting.
So you're subtracting what you just collected in premium,
Yeah.
that $4.25 from the $1,800 strike price.
Okay, all right. So I got it now. All right.
Because in essence, when you're selling puts, you're reducing your cost if you should be assigned that stock at 1,800. Does that make sense?
Yeah.
Okay, so now your cost is $1,795.75 if it should close at 1,800.
Yeah, I got that now. I don't know why I was spacing out on that.
Okay, so if assigned, you're already up $42.50. You agree?
Yeah.
Or $4 and well, yeah. In this case, it'd be.
And to be an assigned that, what would happen to be assigned that?
You would have to put up. You would be obligated to buy it at $1,800, regardless of where it goes.
100 shares.
100 shares.
All right.
Okay.
All right.
Okay. So, but the problem with your strategy at 1,800 is there's only a 74% chance that you're going to be right. So what I would normally do, because it's me, is I would look for something because it's an Amazon and it is wild and it does have a 29-point average true range each day.
Mm-hmm.
And that's something else I look at. When you're determining your option strikes, think about how far this thing moves in a day. Think about worst case scenarios. This one day Amazon was down 50 points and I sold puts in the face of that. And I made money because I figured this thing is not going to go down a total of 130 points in 4 days. I luckily guessed right, but I would look for something that has at least a 85% chance or a 90% chance, and it's only because it's an Amazon.
I want to ask you another question, a little off topic, but you mentioned something about what you just mentioned there, and I was just going to put it there. What was it? You just I'm just reading some of the questions here. I got distracted and I lost my question. Oh, the true range. Is that would be considered an indicator that you would have? I mean, I have an options chain. I don't see that, but that's might be something that you might want to have there, right?
Yeah, I mean, I simply go right on to FinViz.
Yeah, all right.
And I just look in that far right-hand column, and it says volatility. It says average true range.
Yeah, but I have it on, sometimes you could get a chart like the TC2000 will give you that. So I have average true range, and I want to add that. Now, there's a couple things. Do you want to just leave that as latest value, bars ago, current daily? I want to just say that's all true, right?
Yeah.
The daily. So now we have an average true range here on Amazon. So it's between $10 and $13. So I'm just, you made a point of mentioning that, and I thought that was important. So if you have that option to put on if you have that column to put on your option selector, it might be a good one to look at, right?
Oh, I've never used that on the option chain. I'm just looking at the price itself of the stock.
Yeah. Okay.
On FinViz, it says it has an average true range, so it moves about 30 points a day. So if I know there's only a couple days till expiration, should I really be worried about something 90 points out of the money or 100 points out of the money?
No.
Probably not. So those seem like pretty good odds to me. So
yeah.
In this case, I might choose something like you want to sell the 1,800 put, but remember, the further away from Amazon to go, the less you're going to collect in premium. So then it becomes, how much risk tolerance do I have? Do I feel comfortable with a 92% chance that this thing's going to expire out of the money? Or am I more comfortable with 73% thinking that thing is going to rally from here? That's the beauty of options. You can determine the probabilities that you're comfortable with.
Gotcha.
I'm not comfortable in owning Amazon at 1,800. I'm comfortable owning it at 1,760. But you're not going to make as much money out of the money, because if an option premium is based on time, volatility, and the underlying price of the stock, when time is gone, what else do you have left? So what I'm looking to do is sell these ones that are way out of the money.
Yeah.
And for example, you're saying, John, you'd pick up $160 if it was on the sidewalk, wouldn't you?
Yeah, absolutely. So that's a good question, because I was going to bring Anthony into this a second. And when we trade the options, and we're just trading straight up, long and short with the calls and puts.
We're more of a directional trader.
But we get great percentage on these trades. What is your percentage that you look for on an average trade like this?
Most of the times it's between 80 and 100%.
Of your money?
Percentage-wise, yeah.
Or you're talking about success?
So
or
your return on your money is at least 80-90%.
Correct. So if I sell a put for $1, if I can cover it at 20 cents, it's an 80% profit.
Yeah.
Right?
Yeah, sure.
But
with the protection that you put,
I cover it at 50.
But with the protection that you usually put in, you always do a spread, right?
Yeah.
So it's not. I mean, you have to consider that.
Well, no, you can still factor that. If you're saying if you sell a put and you buy a put for protection, and the net on that is 56 cents you collect. I'm sorry. So the net on that, say, is $1.
Yeah.
If you cover the whole spread for 20 cents, how much did you make?
80 cents.
80%.
Yeah,
or
80%.
80 cents. Correct.
Yeah.
It's the same difference.
Question for Rob here: do you sell ITM in the money puts?
Tradometer
How
ES
far
oversold.
do you recommend if the stock is bullish?
I rarely sell in the money puts. There are certain guys, if you remember Lenny Dykstra, after he retired and got in all that trouble, that was his option strategy, was selling deep in the money puts. And same thing, he was taking advantage of the time decay. Because, like I said, 3 guarantees in life: death, taxes, and option premiums will decay. It's a proven fact, as you can see from that graph that we showed earlier.
Do you have a set of stocks that you try to concentrate on when you look for this, trading this technique and using your option spreads?
Yes.
Yes.
Usually higher price stocks.
Do you give me your top 5 that you tend to revert to? If you may.
I used to do Amazon, Google, Facebook. Facebook isn't as good anymore. I mean, Facebook, it would be better now. Apple would be better now. Google, all the higher price stocks, but you have to make sure that there's nice volume in the options that you're trading.
Oh yeah.
Rob, quick question. FedEx missed, so they're down $20-$30 today. Is that something you wait 2-3 more days and start selling put spreads on it, or you don't do that?
Well, what I might start looking to do is, when I see bad news, here, I think I have I have this strategy for bad news.
Bad news strategy coming up.
It's the...
You're listening to Day Trading Radio, by the way. If you're out there listening for the first time, this is one of our traders in the room. Tight stops. We have Anthony in the office. We're doing an after-hours show. If you're not a member of Day Trading Radio, we'd love your support. Head over to Day Trading Radio. Sign up. If you like what you hear, you get to experience these traders trading live every day. We're in the rooms. We have a customized dashboard. You get a lot of alerts. You got to check. Actually, we have a trial going on. So take the trial. Day Trading Radio is a free trial, 10-day trial. No credit card needed or anything. Just sign up. We'll give you a password and come in, and you can trade with us for 10 days and test out everything we got here. Little advertisement there. Hey, Kanenko. Great to see Jared in the room. I followed Jared. He put a shovel in his wife's hand the other day. You know, he thought the world was coming to an end.
Did she hit him in the head with it?
No, I don't know. She was saying something. I don't know. We just know each other through that. And I'm going to take him up soon, going out to his ranch.
Where is he?
He's out in, I think he's out in Colorado maybe, or
You
something.
were over in what? North Dakota or something?
I was in Arizona. I was in
Didn't you just see the
California.
relatives?
Yeah, Oregon. I was in Oregon.
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 I'm falling asleep. I've been up since 2:30.
You always fall asleep in here. It's like I have some kind of sleeping gas on in here.
When you're trading in the
that
middle of
chair.
the morning,
It's the chair.
it's the chair. No, I don't sit in the chair anymore. God only knows what you guys did in that chair. But no, I didn't sleep. Normally I take my afternoon nap, but because of the Fed, you know, it messed everything up. I was in the trading room by 4:30 this morning.
Yeah, you're in there all the time. You're
Well,
early, and you're out
usually-
of there by 10, 11 o'clock.
Well, yeah. Well, if I trade the night, usually I'm in there around 2:30, 3 o'clock because I like to catch the European Open at 3, and then I forget to go on the site. So I was on the site today. I think it was around 3:30, 4 o'clock. But normally, when I'm doing that around 1:32, I'll take a little snooze and catch at least an hour.
Yeah.
But with the Fed and everything, I said, you know what?
was
I
a-
won't wake up.
Yeah.
I'm gonna miss a trade.
Oh, you're so lucky.
So-
Yamada, you can find those on Thinkorswim in the trade tab. So when you go, it'll pull up the options. You could just throw them in there. What we were looking at FedEx, you were saying?
I was talking about FedEx because it had the big miss.
Okay, so there's something out there that I like to do. It's called the bad news implied volatility crush. So what happens is with earnings being out, the implied volatility is all jacked up. There's negative news out, right?
Yeah.
The implied volatility is jacked up because they don't know what's going to happen with this thing.
Tradeometer
So
and Q
tomorrow morning,
oversold.
when this thing opens up down big, the implied volatility is going to skyrocket.
Tradeometer YM oversold.
So, and that's only because overnight the stocks aren't trading, correct?
Yeah.
Market closes, it comes out after.
If it gaps down, it has to gap. Yeah, it has to adjust.
Nobody is playing in the options. The option buyers and sellers are all screwed until the morning, right?
Yeah.
Well, come the morning, after this negative earnings announcement, the implied volatility is going to spike. But that is only going to last for a short amount of time.
That was like considered for this morning, right? This morning. Last night when FedEx came out with earnings, that's what we're talking about. Till this morning.
Right.
Yeah.
So when those options open this morning, in the first few minutes or 10 minutes, the implied volatility is going to spike because once it opens.
Oh
down
yeah, I
20
get you. All right.
points,
So yeah.
Is it going to drop 50 points? Is it going to rally back and fill the gap that it created last night? Is it bullshit news? What's the deal? Regardless, there is uncertainty surrounding this stock, which is going to cause a bump in implied volatility. So as Jody mentioned earlier, I believe, she said, don't you want to sell implied volatility or volatility when it's high?
Yeah.
And
Exactly.
the answer is yes.
Exactly. That's
So
your
what's
best
gonna
scenario.
happen? So what's going to happen to puts if the stock is dropping overnight, pre-open overnight after the close last night, pre-open it's dropping. When it opens,
Yeah.
aren't puts going to be the most valuable
Yeah.
at that point?
Yeah.
Okay. So if you're like us where you like to play gaps and you know that the best thing to do inherent in the market is buy low, sell high, what do? You buy the gap down if you're a stockholder, right?
Mm-hmm.
Or if you want to initiate a position, best day to buy it is on a gap down. Wouldn't you agree?
Yeah.
Okay, so with the bad news implied
So
volatility going
the
on,
best day to buy
the
would be.
implied volatility is pumped up. When those puts open, they're going to be inflated.
Mm-hmm.
So you want to sell that inflated asset that is going to decay in price because once the market opens, guess what?
The time is
There's
the
no
clock
more
is
news
running,
out there.
and the clock is ticking.
The clock is spinning. Correct.
Specialist.
So
Clock
give
is
me.
starting to spin again.
This is a great question from me to you. I took the position in Roku today. It gapped down, but it continued to go down. So if I would have sold that volatility, but the stock continued to move down, would there be a balance between, because premium would be decaying because of the time decay would kick in, but the price continues to go down. So which would be a better? I mean, would it even out? You know what I'm saying? Like,
it may or it may not, John, depending on, there's other factors considered. How long, you're 2 days from expiration.
yeah,
It depends what strike price you want to sell. I don't know what the probabilities were in the morning. And with that inflated premium, I'd have to think, even if the stock dropped and you sold puts and you had enough of a cushion, I think even with the stock declining, you would have made enough in, well, I shouldn't say that. I was going to say I think you would make enough in decay to offset the drop at the price drop in the stock, or the further drop in the stock. But
yeah.
it's hard to say, John, without looking at it.
Because
I would have
because
to
of the
look at
volatility and the
probabilities.
stock, does it go by does the a lot of the calculations go by the type of, like, the beta? What's how do they add in the premium?
It's really just the underlying price of the stock, the time value
Yeah.
left in the option,
Because sometimes you see these things are extremely over.
and the volatility.
Yeah.
So think about this.
But I'm saying, what's the volatility? How do you break down volatility?
That is just the volatility. You would just say is the, what's the word I'm looking for? Uncertainty of the stock, I guess, is the best way to
Yeah.
describe it.
All right, so I'm just looking at that. So I picked up Roku on the 50-period moving average, right around that 130, 133 area. Yeah, I think I added to it a little bit lower, and it continued to move down to 128. Now these are expiring tomorrow. I was hoping for a rally like we saw in the market,
Right.
but we didn't get that. So these things didn't move.
I'm in the same position as you are, but I went out
Which ones you
until the
own, John?
27th.
I picked up some Roku calls today. I got the
Expiring when and what strike?
Tomorrow. I got the 133 and the 136. And I bought them down here hoping for a bounce, but they were actually down today.
Okay, the 133s that you bought,
Yeah.
just so you know,
They're 183.
they have sorry.
They didn't really expire. I mean, 183s, even though they're they're down here $1.29 or $129. It didn't really go down too much in premium. I mean, it's still trading right around that level.
Wait. You bought the 133 calls?
Yeah, and I paid $1.95 for them.
Okay, going into that trade, it has a 74% chance that it's going to expire worthless.
74% chance, yeah. Now, what brings that? How do you get that percentage?
It comes. It's just a
It's
probability.
just, yeah.
You can use delta.
Well, I mean,
If
because
the delta's 10, then you got.
because it's very close. I mean, if we were, that's very
Any
close
sort
to
of
the
a
strike
pop,
on a
yeah.
very strong stock.
We were down $23 today.
Yeah.
So all you're looking for
I'm
is
not looking for a 2 or 3 point
that's it.
pop, a
Listen,
4-point
but
pop.
Honestly, I would say by Friday we'll be right around 135 again.
Yeah, I would think so
I
too.
will-
135.
It's John. It's actually not my rule, but I learned this from Chuck Hughes.
Yeah.
And as far as the math goes, he always stressed, do not buy an option that's more than 1% out of the money,
All right.
because it's too hard to recoup that. And look, how far out was that call? It's at 128, you said?
Yeah. All right. What was that
So
question? Go ahead.
You currently have a delta of like less than 30. So if the stock moves $1, theoretically you should make 30 cents. So right now you basically have like a 74% chance of it expiring worthless. Now, let's look at the contra.
Yeah.
Great example. So you bought calls,
Yeah.
and you have a 74% chance of being right. No, I'm sorry. You have a 30.
Yeah, it would be.
Sorry, you have a 26% chance of being right or profitable.
Yeah, I don't like those odds.
I don't.
No.
So it's 74% chance that it's going to expire out of the money. Let me see what put options are going to expire 74% out of the money. I can sell the 122 puts that have a 74% chance of expiring out of the money, and I'm collecting a premium up front. So you laid the money out of your pocket knowing you're probably going to lose.
Yeah.
I'm collecting money, hoping to win with the odds in my favor.
Yeah, yeah. That's it sometimes. Sometimes you go into the casino and you know that's a high risk trade. Actually, the trade I did post it was a high risk trade. I didn't, I wasn't very comfortable with it, but I did think that Roku eventually would move higher.
Well, it's up 300% for the year, so you figure it's going to do some sort of a bounce. Plus, it's pulled back. I think it was 170 last week, 168. So it's down almost $40. So you have to figure a $10 swing. That's the way I was thinking of it.
Yeah.
Rob, listen, I got to say goodnight because I got to get some sleep, or I'm never going to be online by 3:30 tomorrow morning.
He's just Anthony's checking out here, but I'm here with you.
Listen,
ahead,
feel better,
old
Rob.
Yeah, feel
Thanks,
better,
man.
Russ. There is a lag. Well, I have a lot of things running. I'm recording the show. When you say lag, hey, take care, Anthony. Thanks for stopping by. Better now. All right, so let me see. Turn his volume off. He just took off. He was falling asleep in the chair.
Old lady.
Hey.
So, John, what are you looking to make on this trade, you think? Roku.
Well, I didn't, I was looking for it just to bounce and take it off on a bounce back up to 135-ish. I think at the time, I was looking a little bit higher.
Well, Monday morning quarterback.
Yeah.
In this case, if you expected it to go higher, you should buy at least, at the money or in the money options.
Yeah.
I know you say to yourself, well, I'll save some money because I'll buy it out of the money. I'll buy a little bit away, but you're at a disadvantage.
Yeah, no, I see that now. I mean, it's good to hear this tech, especially when there's a news event out on a certain stock and you get that spike in volatility and you can really take advantage of the premium that gets jacked up. It just makes it such an easy, we needed to do a show like this where we really point out the advantages of doing something like this. I think I will do this more often. And with
at least to get your head thinking this way, John.
Yeah, exactly. I mean, especially if we do have that spike in the volatility of the stock, being a drop or a pop. I mean, if something
Order submitted.
1 minute by divergence.
No, I was going to say, I was very
Order
fortunate
filled.
in the fact
Order
that
submitted.
I learned early
Order
on in
submitted.
my Wall Street career.
Order
I used to
submitted.
work with an old guy, and he was an old margin guy. Like, he worked in the margin department in the back office, these old crabby old guys, chain smokers, liquid lunches. And I sat with this guy one day when I was first started, and I said to him, he asked me, he said, "You trade?" I said, "I got a few things in my portfolio." He's like, "What do you own?" I'm like, Johnson & Johnson, Exxon, Staples, shit that I knew at the time. So he said, I said, "But I really want to own this, I said, I just bought some calls in something, maybe J&J or something. And he goes, "Why would you lay money out of your pocket?" And I said, "What do you mean?" He said, "If there's a stock you really want to own, don't buy calls, sell puts." I said, "Why the hell would I do that?" And he said, "Well, you can sell puts And if it goes up, you collect something because you sold it. He said if it goes down and you can actually own it at a cheaper price. Because remember, when you sell puts, you're collecting something up front, and whatever that strike price is that you sold, you're going to reduce your cost if assigned by what you collected in the premium.
Yeah.
So,
well, you know
I
what?
will only sell naked puts on stocks that I feel comfortable owning or want to own. The diabetes stocks, of course, you know that.
Yeah, I
Sorry,
I understand
ask
that,
something
Jody.
else.
All right, so you know what we need to do is, include it in your insider report. You should jump on anytime you see a great opportunity to imply or implement this strategy.
We
Well,
do it all day.
Yeah,
We
I know
look
you
for
do it all the
opportunities
day.
every day.
I know. Yeah, there is
know.
opportunities.
A lot of times I post them in the futures room, which I'm sorry, I should do more in the main room with it. But there's just a lot of I can't see anybody wanting to be a buyer, knowing that time decay is gonna
Sure,
work
it does.
in your
Yeah,
favor.
time decay is it. It's like, it's so obvious that time decay is going to work against you. It does work against you. It's just finding the right. Lots of times you'll buy a stock that gaps down and continues to go down. There is occasions when a stock will pop and, it'll continue to move higher, right? Where that would work against you.
No, if you sell a put and the stock moves higher, that's what you want.
Well, no, I'm
'Cause
saying.
you're bullish.
Yeah, no, I'm saying the other opposite. If you were selling premium, or do I have it? I have it backwards now. Yeah, I have it backwards. Buying premium. Is it buying premium?
Buying premium is not what you want to do.
No.
You want to sell that premium. I mean, there are times, yes, when I do buy premium, but if I do, I buy in the money. If it's out of the money, it can't be more than 1% away, because it's just too hard to make that up. And especially as you see on that decay graph, at the end of the week, you definitely don't want to be a buyer.
Yeah, absolutely.
You want to be selling.
Rule number one. Do you have any more
Sands
charts?
through the hourglass. Sorry, what were you saying, John?
I was saying, do you have any more charts that you wanted to share?
Let me think about it. Well, I wanted to try and
Yeah,
give
let's
people
continue
other
on.
examples and stuff like that. So
You have the mic. I'm trying to think of other examples too. The last thing we looked at is how the premium really decays into.
that is the crux of, that is the logic behind selling premium. You're selling a depreciating
Order
asset.
filled.
It's
Order
decaying.
canceled.
There's a
Order
finite amount
canceled.
of time before that thing is done. So if you can place your bets towards the end of the week, you have the closer to the end of the week, the better chance you have of making money. But you sacrifice that you've already given away all of that time decay. And although you might be profitable, you could have been much more profitable if you guessed right earlier in the week. But it all depends on your risk profile. Don't risk more than you can afford to lose. And if you think like you said, for example, you thought it was going to drop to 1,800, worst case scenario, the Amazon.
Yeah.
Give yourself some room in case you're wrong. A lot of times what happens is you think, oh, I'll sell that 1,800 put because or I'll buy that 1,800 call because that's where all of the volume is, and you'll end up seeing the thing close 5 or 8 points below that price that you thought it was pinned at. So, I'm sorry, they throwing out questions.
Yeah, I'm setting up Rockstar. I'm setting up a long-term portfolio soon, and we need to do a show about it. Would not be nice if we could get your wife on as well. We can go over tax. All right, taxes. Just
Order
an idea,
submitted.
amigo.
1 minute by divergence.
That sounds great.
Order filled. Order
Sounds
submitted.
great.
Order submitted. Order
Bojango's got to know
submitted.
your ATR, especially for options.
Yeah, it's definitely, it's something to take into consideration. Normally, I would not usually sell Amazon that close, like in the example. I would usually go further out,
I think Tight Stops
unless it was a move down.
I think Wingnut mentioned earlier, can you do this in a non-margin account?
You can do this in a cash account, but I'm sorry. Let me put this differently. You can do it in a smaller account, but you have to do put spreads because you're covered.
Yeah.
It would be if you do spreads, it's a different tier of option. What's the word I'm looking for? There's certain levels of options you can do. There's tier 1, tier 2, tier 3. The most basic is just buying calls and puts. The second would be selling covered calls. And I believe put spreads might be number 3. But yes, you can do it in a smaller account because you're going to put up less capital because you have the protection of the protective puts in the put spread itself. And that's a way, and that's the other thing too. With selling premium, you're not going to make home runs. Yeah, you might, if you're bullish on Amazon and you buy calls and the thing rips 50 points, yeah, you're going to make significantly more than you would if you sold the puts. But the probability of success is so much greater in selling those puts, even though it's a smaller payout, the probability is higher. I'm fine with that because I'll tell you what, all of these small wins, they add up. And if you got an itchy trigger finger like I do and like Johnny does, as soon as you see that profit on the screen, you're starting to take them. There's nothing wrong with that. And when I'm selling option premium, that is my goal, is to make money quickly. Couple of days, few days. I rarely let this thing expire worthless because,
Order canceled.
The fact that Amazon does have a 30-point range on any given day. Does that make sense?
Yeah, absolutely.
Why leave that risk out if you've already captured 90% of the decay or 80% of the decay in your trade? Is it worth it to leave that money on the table and maybe get a sign because you went to play golf? Hell no. Don't do it. You sell put spreads and you get a 50% profit, cover partial.
Order
Get
submitted.
60, 70%,
1 minute
maybe
by
think about
divergence.
taking it off.
Order
You get
filled.
to 90%,
Order
definitely
submitted.
close it out.
Order submitted.
You
Order
made
submitted.
90% of your money on every trade, you'd be teaching me.
Yeah, you're right.
I'm just saying this is not the end all be all. There's a million ways to make money trading options. Some guys push condors, stuff like that. I only turned this trade into a condor because, like I said, I was pressing my bet and I wanted to show a good example for the show, and it also showed that you can win both ways, and you don't have to be right. You buy a call, you have
Order
a 50%
filled.
chance of being right. You sell a put, you can win 4 out of 5 ways. If you sell a put and the stock rips, you make money because it's going to expire worthless. If it goes up a little bit, you make money because it's going to expire worthless. If it goes flat or sideways, you're going to make money. If it goes down a little bit, you're going to make money still because you've already captured the time value. You're capturing time value as the clock spins till Friday. The only way you lose money or can lose money is if the stock drops drastically.
Yeah.
So going into this, that's, I guess, where they say, John, there's 80% chance. It could go up. It could rip, it could go up a little bit, it could go flat or sideways, and it could go down a little bit. 4 out of 5 ways you're winning. The only way you lose is if the stock gets pummeled. So right there, okay, I guess that's where 80% comes in, John.
Yeah.
Then when it comes time to picking the actual strike price that you're going to sell, I look for probability of at least 70%, hopefully more, I'm actually fairly conservative. I might seem like a cowboy with futures trading and some of the positions I take, but when it comes to options, I'm using the limited liability and the high probability of success, and I'm also using the time decay.
Here's Yamada saying, "On rock, gotta go, Magoo. Have a great evening." Um, Zouch says, "How much can you expect to lose if it tanks per contract when it happens?"
It all depends. It depends how far from expiration you have. It depends how far away you are. This stock may tank, and you still may make a profit as long as it's above that strike price. Even if it closes right next to your strike price that you sold, that you were already up, hopefully the decay will kick in fast enough where you don't lose any money. But can you? Yes, definitely. 2 days to go. If the stock starts tanking with 2 days to go and you have a profit in it, take your profit. Because chances are, if that thing sells off, you might be able to re-enter that put or that put spread lower and make even more money.
Wow.
For the subsequent bounce. It's not a hard and fast, it's not a holy grail. It's just
Kimberly Clark, I just happened to be looking at it, just the thing. Nice divergence, daily divergence on Kimberly Clark, KMB. I don't know why I just mentioned that. I don't want to forget it, so I just want to throw things out if I see it, KMB. Not that we could...
that's a good question. Somebody just asked me.
What?
What are your most consistent strategies?
Yeah, I was going to ask you that. He probably stole it from me.
Hey. I have to give props to Rockstar for this, because if it weren't for him, I would have never looked at these. And again, I give John props because I swore I would never be able to figure out what he was talking about. And that would be divergences. Divergences are what keep me coming to the table every day.
Yeah.
Normally. You couple that with a Keltner setup and a divergence, that's my...
bread and butter.
That's my bread and butter right there. Another one, obviously, we've talked about it in the past, and there's a show on YouTube if you want to listen to the particulars. It's on Johnny's channel as well. It's insider purchases.
Oh, yeah. And Rob's an expert
Not
at that.
insider trading, but insider purchases. We have a strategy for that. And another one would be selling premium. So, and also gap downs. The gap plays at the open based on yesterday's close. Those are primarily the main ones. There's other setups that I like and that I'll take, but as far as strategies goes, it's insiders, it's divergences, it's gaps, and what we went over tonight, selling premium.
Yeah, it's all tools in the toolbox. I'm new to selling premium. I never really did it before. I was so happy to do this and listen to the whole thing. I'm still learning the options. I like trading the options.
I know it's a lot to try and understand the intricacies of all of this stuff and the terminology and how does this fit in and how does that fit in. I just wanted to give an overview of the concept behind it.
Yeah.
When I sell puts, I don't care where the stock goes. I just want to know where it won't go. And where it won't go, there's value. It may not be as much as where it might go.
Yeah. So you would rather I'm
a wuss. I'd rather take something that has a 90% chance of expiring out of the money every time.
If you wanted to sell puts up against like a resistance area or a something that's topping out or a sell divergence or something. I mean, you still want to use your indicators to plan out these trades.
Yes, no doubt about it. I use stochastics, I use fib lines, I use, Keltners. But again, they're all I mean, with the exception of fibs, the indicators are lagging indicators.
We just had we just had a little divergence right here on the ES. If you look at it, you saw that little candle. We had a little pop, consolidating here now. Futures, just an update, are trading off 5.25 here, and we're trading here. It's live after our show. We have tight stops here with a little after 10 o'clock. We had Anthony here. Really enjoying the show. Hope everyone's enjoying it. DayTradingRadio.com will be broadcasting live tomorrow, as we do every day, 8 o'clock in the morning until 4 in the afternoon. And
Dash is asking, how do you know how wide to build your spread, and what are some good rules for when to bail and close out the trade?
Yeah.
Like I said, on the short put in a put spread, I usually try to collect at least, I don't know, it usually should have a 75 to a 85% chance of expiring out of the money. And then I'll buy the cheapest protection I can, even if it's much further away, just because it's going to cost me less for the protection, and I'll be able to have that much more leverage to buy more, to trade more options. Closing it out, like I said, when you get to 50% profit, I would probably start covering.
It's a nice profit.
Yeah, if you can make 50, if you could sell 10 puts and make $1,000 and cover it a couple hours later for 50 cents and make $500, I would take that trade 100 times a day if I actually had the capital.
Yeah. Just had a thought here, and I have to get it back. Big shout out to RPM out there. And what was I just going to mention here? Something. Keep on going. You know what I was going to say? If anybody has any examples they want to maybe, I'm going to ask
Dash.
I want to ask your permission first. But if anybody has a possible trade setup that maybe you want to throw in the room, and we could let Rob take a look at it, maybe set it up. If you think it's let's stick to the spread here trade. Trading the spread for income type of topic, and maybe because I have a couple too. I was just thinking of some stocks that maybe I would think that might start to decay pretty fast, and I haven't looked at them yet. I'm going to look at them with you right now. What was this one I wanted to look at? Oh my God. Well, let me see what Funko's doing these days. I hate that stock. It's up here pretty good. It kind of has an island. It has an island reversal. This is a little pattern that it's kind of interesting. I like the island reversal pattern where a stock gaps up, and then I'm trying to get, there it is. It's gaps up and either gaps right back down or has a couple days and then it gaps down. This is a very bearish setup here. Now we have a bearish setup back here with the divergence. I mean, you can't deny the divergences. I tell you, even that little divergence on Funko pulled it back about 8 days before it got oversold. Here we have an island reversal. Gapped up, now gapped down. Say we're going to just, set up a trade for me on this using the spreads. Can we do that? Or it might not even have enough volume in it, actually. I don't even know. It might not be a good example, but if anybody has something they want Rob to maybe take a look at, we'll take a few of those. It could be anything that has the right, he'll tell you, hey, that's not a good trade to do it with.
Yeah, Funko's tough, John, because it's got big spreads. There aren't a lot of option strikes.
Yeah, that's not
there aren't a lot of expirations. It's only $25 name.
Yeah, no, I didn't. Yeah, I didn't think it was going to be a good one.
Wait, just saying Burlington. Let's take a look at Burlington.
Take a look at Burlington. Someone mentioned that earlier. Burlington Coats. Big stock. Maximilian likes to trade this. It gapped up here on earnings, and now when it gapped up, this would be the area you would really want to concentrate on, right? I mean, you'd be raking it in right now if you were.
Yeah, I mean, this gap up though, it gapped up to a Keltner. That would be That would be a key. That would be a cue for me to sell a call spread at this point. And it did. It moved down from 209 all the way back down to 189. And now it's starting to climb back up.
Yeah.
So if you didn't think that this thing was going to, so what's that gap that it has to fill? 174? All right. So let's see what kind of options look like for Burl.
I got them up here, too.
And granted, the other thing is too is I like to focus on weekly options, but I will go out a couple months if I really have a good feeling on a stock and I don't see it, selling off at any significant amount.
Average.
I will go out 3 months. Here, I have an example of one that I'm long right now. We can look at.
Okay.
Sorry. Okay, so this is one. Now, granted, this is a little bit riskier. I'm doing something that I don't recommend anybody doing until they, know the full consequences of their actions. But, John, pull up Tandem.
All right. Hold on. Let me bring the chart back up here. Tandem diabetes.
Okay, you guys know how intimately involved I am with the diabetes stocks and the medical supply stocks. Well, Tandem is one that I like. Recently came out with earnings. They were spectacular. There's an untapped market in Europe for diabetes supplies. Diabetes is on the rise in Europe as well because they're like fat America. They're catching up to us.
Yeah, you're right.
So...
it's actually a nice
I took
setup.
a look at the chart.
It's nice.
I took a look at the chart in Tandem, and I said to myself, well, where would I be comfortable owning this stock? And I came up with a $45 price point I would be comfortable with owning it.
Wow, that would be breaking under the 200 period moving average.
Correct.
Underneath the recent low, back a year low.
And if I'm not mistaken...
All right, so we'll put that number down there. All right, so 45.
Yeah, let me look at your chart. Yes.
Around there.
Okay, so just spread that out, John, so we can see.
Yeah, I will. Excuse me, a couple sneezes there. Let me get my pointer out here. Oh.
Okay, so just so you can see it in line. Okay, so Tandem, I figured if this thing drops to $45, I want to own this thing. I'm comfortable if it drops to 45 and I get a sign, they say, Rob, you own it at 45. No matter where it goes, I'm comfortable owning it at 45.
Yeah,
so,
all right. That sounds like a good level. It does look like a good level.
Okay, so on August 14th, I sold 10 of the 45 puts. Strike price of 45.
All right. I don't even know if that's the right date, but...
So right now, I've been in this trade for 1 month. So I sold it on 8/14, and today is... So August 14th, I sold it, and now we're at September 18th. When I sold that January 45 put, that expires this January, so it's got still 121 days left in the life of the option. I collected $2.85 because I sold somebody the right to put that stock to me.
Yep.
Right? You sell a put, you're obligated to buy that stock, or somebody puts it to you, meaning you buy it. So if this thing should close at $45 or less by January 21st,
Yep.
I will own this stock at $45.
Yeah.
But the fact that I sold somebody the right to put it to me or forced me to buy it, I collected something for that right.
So when
And
you do that trade, and say for every contract you're obligated to buy 100 shares of that stock at that price.
Correct.
So do you have to have that money in your account before you take that trade?
Correct.
The total cash value minus whatever the margin is.
Right.
Yeah.
So what happens is, so if for some reason Tandem drops to $45 or less, I own it at 45. I have to buy it in the marketplace at $45, but my actual cost is only $42.15 because I collected a $2.85 profit for selling somebody that right to put it to me.
All right. Now, what if you didn't have the money at the time? Does it automatically?
You would get a margin call.
It doesn't automatically do the calculation, say, well, you'll be ahead by $3 anyway, and it just.
Nope.
No.
You will buy it, and it'll automatically execute in your account. If it drops below $45, $44.99, you own it. Regardless, maybe it drops to $30, but you own it at 45.
Yeah.
But I'm doing something risky. I didn't buy any protection.
Yeah.
I sold naked puts. The only time I will sell naked puts, meaning without protection, is with something I feel comfortable owning. And I do feel comfortable owning Tandem Diabetes at $45 per share because I know it has fantastic prospects. It's in a great space. I'm not telling you that people to buy Tandem. I'm not.
But if it doesn't get down to there, you're making money.
I collect that $2.85
per
Tradometer ES oversold.
per contract. So in this case, if this thing closes at say $50,
yeah,
the long owner of that put is not going to put it to me because it doesn't make sense. If the stock is at 50, why is he going to sell it to me at 45?
Yeah, yeah.
So his puts will expire worthless. My puts are going to expire worthless.
Yeah.
But I've collected $2,850 for that right.
Yep.
Selling somebody that right to sell it to me. Does that make sense?
Yeah, it makes total sense. That's a good example right there.
So, if you're comfortable owning a stock at a lower price, why not sell puts at that strike price and you'll get it even cheaper because you're going to collect something for that right. So that's why this wise old guy on Wall Street said, if you're bullish on a stock, why buy calls? Sell puts. And one guy next to me said, well, I would sell puts, but I'm scared to own it. I was like, I don't want to own it at 45. I said, well, you don't own it at 45. You own it at 42 and change.
Yeah.
Now, somebody asked me the question, well, what happens if you get assigned at 45? Then what do you do? Well, the first thing I would do is I would sell a 45 call against that stock that I now got assigned and do a covered call. I'm going to collect something by selling that covered call, and it's going to further reduce my cost basis. So now I'm not long at 42.15 anymore. I collected premium on that covered call that I sold against it, and I collected maybe another $2.15. So now my cost is only 40. The stock is trading at 45 and maybe higher. So now I sold a 45 call against my long position. If it goes to 50 and I get assigned, they take it away at 50, but I'm long at 40.
All right, we're looking at FedEx now. Paul is texting me twice on FedEx. He wants me to ask you about FedEx. See if you can come up with something for FedEx. The weekly bull divergence looks huge, gap down, et cetera, et cetera, et cetera. Now, I don't know if this is confirmed divergence, but I know what you guys are looking at on this divergence. I know it's a quality name. Yeah, the
He's
low.
looking at the double bottom and the stochastics
Yeah.
haven't rotated back down.
Yeah. But
Okay.
you know, so he wants to know. He says here, ask Rob, see if he could come up with something. Ask Rob about FedEx. Love the weekly myself. Watching from the bed. Oh, he sent me a picture of this bed. Thanks,
Oh, great.
thanks, Paul.
Thanks for sharing that. Let's see FedEx.
Now-
Closed at 151, call it.
It's a dangerous stock too. I mean, because considering Amazon, I am scared of FedEx just because of Amazon. That's why I'm not trading. You know, I don't like FedEx. I personally.
I'm scared of FedEx because I think it could go to 130.
Well, there you go. Yeah.
So maybe not the greatest example. Let me reiterate this. So you asked, selling puts is probably the best strategy in a bull market.
Yeah.
Selling puts is one of the best things you can do in a bullish stock. I don't believe FedEx is bullish at the moment.
No.
Could we get a bounce? Sure. But in that case, I might roll the dice and buy an in-the-money call.
Yeah.
Because that's the most I'm risking is what I pay for that premium. Whereas if I sell puts in FedEx and the thing continues to go south, you know, even if I buy FedEx calls and I get stubborn and I let the thing go to expiration and it expires worthless, the most I'm going to lose is what I paid for those calls. If I sell puts and I get stubborn and the thing drops 20 points below my strike and now it's looking like grim death, I want to be able to sleep at night. So I would not, there could be some unlimited risk unless you do a put spread in FedEx. And even so, I don't think I would want to do a put spread in a stock with bad news. Unless you think the story is total horseshit, but they had earnings, right?
Yeah, they guided lower. That was some pretty bad news. That didn't look good.
Okay. I mean, if you thought this thing was going to bounce for any good reason,
We'll see. When,
would I
you know,
recommend selling a put or a put spread? Probably not. I would rather find a strong stock that is pulled back, that has better prospects, like some of these ones that I should really look at the ones that Maximilian points out because he usually only buys strength.
Yeah, he does.
So
Paul likes FedEx because it delivers all day on Saturday, and UPS won't touch it.
I like that. It's seen this level It's seen this level 3 times already.
So if you're looking at being comfortable owning it at 130, and what if you say this was going to go down lower, and you were comfortable buying it at 130?
Yeah, I probably wouldn't.
Yeah.
The FedEx is not something I feel comfortable owning, especially in this landscape with Amazon. And
Oh, yeah.
I used to do really well with FedEx, and then Amazon became the powerhouse that it was 15 years later, and I find myself not even touching this.
Gotcha.
I do like the setup. Would I do a put spread or naked puts? Probably not in this one. Somebody give me something that's been... I know what we can look at. Here's some of the ones that I would do put spreads in. Listen up, people. I like Visa. Full bull mode. MasterCard.
Yeah. Yeah.
Sherwin-Williams.
It's HW.
The only negative thing about Sherwin-Williams, and I did do a nice put spread in it a couple of weeks ago, the options are really thin.
I can't believe this thing is
Spreads are really wide,
trading a freaking
and it's a $500
$500 stock. Who would have guessed? 2012, it would have been like this. I mean, that's crazy.
John, I owned it at 150. I sold it for a 5-point profit, and I thought I was a champ.
Yeah.
And I turned out to be a chump. So, again, you're going to sell puts. Do it in bullish performing stocks. Do it when conditions are bullish. You may not collect as much premium because volatility is probably low if everybody's happy and everybody's got that warm, fuzzy feeling, and Captain Orange can't say anything bad, and this market's going to keep rallying, and they keep printing useless pieces of paper, and the S&P just charges higher above 3,000. Selling puts, selling naked puts, selling put spreads, it's one of the most consistent and profitable strategies in a bull market, whether it's the stock itself is bullish or the overall market. And if we remember from history, 4 out of 5 stocks move in the general direction of the market. So if you are in bull mode, sell puts. Just make sure you sell them at a level you feel comfortable owning or you don't think they're going to get to. If you think Sherwin-Williams is going to get to 500 because it's at 550 now, you think it's going to drop to 500, give yourself some cushion. No heroes. Maybe sell the 480 puts. Give yourself 20 more points of cushion.
Paul just texted me. He wants you to take a look at RPM International.
Oh.
That's actually a nice looking stock, Paul.
Hold RPM for the long haul.
Yeah, that looks like a good stock there. I like that.
Johnny, where was it when we were doing when we did the phone call?
Well, hold on. I was just there was a phone call coming in here a second ago. Just don't ruin my surprise, because I think we have a special call coming up.
I am right here, guys.
Who's that?
It's Frank. I've been listening here for 2 hours. It's a great
Oh,
show.
it's Sonny. Oh, no. Sorry, I thought it was Sonny.
It's Frank. Frank is on the line.
How you doing?
Hey, good. What's
Frank,
up, Frank?
How are you?
Yeah. Hey, I started this night. I was just outside of Toronto, and I'm more than halfway to Montreal now. Great show.
I've been following you on Facebook, Frank.
Excellent. Well,
I
you
saw
know
that
what?
you're up in Canada.
Yeah, I met my girlfriend on Match.com. I just want to put that out there.
Yeah, no, that was good. Did you say you got engaged? Oh, maybe I ruined the surprise. I remember something saying, oh, maybe you were in a relationship, but you said on Facebook or something.
Yeah, that's right. You got it.
All right, gotcha. I don't want to break the news before the news is broken. Sorry.
It's heading in that direction.
Oh, that's
So
great.
I might want to sell or do a put spread on it.
Yeah, so put stuff on the engagement.
Anyway, I wanted to ask about 3M. Kind of active in that. I have a smallish cash account. I want to try the strategy out on that Rob has mentioned.
All right. Well, I like to read.
It's
So let's go ahead. Sorry, I'm too excited.
One thing I wanted to point out. I like the illustration of selling the rotten fruit. Who's going to buy that at the other end? Well, that's everybody that wants insurance. I mean, insurance is a product. You want to be selling it. I just figured that's an illustration too to help somebody new like me understand this a little bit better.
Did you get that, Rob? Hello? I think we lost Rob. I think Frank got on. Rob got off. I don't know what happened. Let me. I'm sorry. I didn't know what happened, Frank. I was hoping that Rob would answer that question for you. I could barely hear you, but
Yeah.
I could hear you, but I could barely
Me a
hear.
little bit better now. I just have to be closer to the microphone.
Oh, here comes Rob. I think Rob. If I kick you off here, Frank, I'm sorry because Rob's calling back.
Hey.
There you go, Rob. Sorry, what happened? Did I kick you off?
I think so.
No, impossible because I didn't do anything. All of a sudden, I heard another voice.
Sometimes when other calls come in, it kicks us off.
Yeah, and there is so Frank is on here. Were you on with Frank before? You were, right?
Yeah.
All right,
Yeah.
there.
Obviously a Canuck.
Obviously.
Yeah, Rob, I was asking about 3M. Would that be something you'd look at for this strategy?
Let's take a look.
One
Well,
of my favorite
this.
stocks of all time.
All right.
On disclosure,
Well,
I'm long 3M, just for disclosure. I like it. It's one of the. I like this flag. I like to hold in the 200 period, the 20 period moving average. I like everything about this on the pullback. If we scroll out on the pullback here, you can see we're off the highs here. The highs up here around. I don't even know where the highs are up here. 260, trading at 167 now. And we're back above that trend line. Remember I talked about that trend line holding. So if we're looking at this going up, what would be your strategy?
all right. So just in first looking at this, I see 3M. I'm looking at a weekly chart, John, and I see a slight weekly buy divergence. If you want to point that out.
Yeah, a weekly buy divergence. Take a look at that. Yeah, slight. Yes, definitely see it here.
Right,
And
slight.
Assume I've got 10,000 to work with on this one
Okay.
particular setup.
Right.
Okay.
Hold on. Now, let's see something. All right, so let's go and look at the options. So we know on a weekly and daily basis, this thing could probably move higher. So let's look at the options then.
Yeah. All right.
So it's trading at 167.5 approximately. All right, let me look at something first, and I want to look at the volume in some of these options.
And as he's looking at them, I have them on the screen. But what strike you looking at? How far you are you starting out?
Yeah, the only problem I see with this is, well, wait, how long are you, when are you expecting the move, Frank? What kind of move you're looking for and how quickly?
About a 50% move in a couple of weeks, basically. When I traded my last option.
So you're thinking it gets back up to maybe that recent, like 218, 219 level?
No, I think he's like. Do you want a 50% on his trade he wants, or do you think a 50% a move on 3M?
Wow, that'd be a heck of a move.
Yeah, I know. I think he's thinking of the option. He wants to get a 50% return on his trade.
Oh, okay. I see what you're saying.
Yeah. So let's just talk about the 200 period moving average, that candle up here, which would be about 187. I think I have a target on here. I think it would be easy enough to get up to 180. I mean, can we talk about 180 right now? Just see what we could figure out, and then we'll move from there.
180 makes more sense, yeah. And Johnny, when you bought those two calls, it was at $1.71 each for October's.
Yeah.
A couple of days later, I snagged the same ones at the exact same price for $1.71 a piece.
Oh, perfect.
Yeah, but the thing is, I'm stuck with this expiring rotten fruit, and it's one of those things where it's just going to get stinkier and stinkier at an accelerated rate. At an accelerated rate, that's what he's trying to say. You get most of the deterioration in the last week, and then you get the last day and last hour. So yeah, I understand.
Okay, so let's say, for example, so you think in probably like the next 2 weeks this thing might get to 180?
Yeah, let's just say that.
Yeah, let's go with that.
Okay. So one thing I was saying with selling premium is I don't care where it goes. I just care where it doesn't go. So what do you think where do you think this thing would drop to, worst case scenario?
160.
160? Okay. So
That's
right
the
now,
here, yeah.
okay.
And that's a quality name. It's like Kraft Heinz. It took another kick in the can after that earnings report for them. But I'm not really looking at Kraft Heinz because it's a $25 stock. Here we're talking 3M. We're closer to 200, and I think this would work better for that kind of setup, or even a Boeing, for example.
Oh, definitely. And I said I like to choose the higher price securities that are fairly liquid. A lot of the household names.
Exactly.
160 is not bad. So what you could do is you could sell a 160 put that expires in 16 days.
Okay.
Right? That
Yep.
should encompass the move you're looking for, correct?
Yes.
Okay, so if you're expecting in the next 2 weeks this thing is going to be 13 points higher, you could sell a 160 put and collect 86 cents.
Okay.
And you said you want to make at least 50%, you think?
Yeah, you were mentioning earlier about different, you want to cash out conservatively, 50%. Good profit
Right.
margin.
Right. Well, you have to remember you can sell any strike and make probably and look for a 50% profit. Well, what's going to be worth it to you? Is it worth collecting 19 cents to make 11? Or would you rather collect 86 cents and maybe make 43 cents? So what I'm saying is, Frank, I can make you 50% in pretty much any strike.
Okay.
It's a question
Order
of what are you
filled.
willing to
Order
risk.
canceled.
I would do the 86 and 43 for that.
Okay, so
Yeah, so now the protection part of this, you have to also buy it, but so the spread.
Tradometer YM oversold.
Where will we buy this? Where will we buy the protected put?
in this case,
Okay.
yeah, so you could sell the 160 put and collect 86 cents as of, based on closing numbers. You could collect 86 cents and you could buy protection at 150.
Right.
And you're making almost 40 cents on the spread, almost 50 cents.
Yeah.
But you have a $10 difference in strikes.
Okay.
So that's $1,000 for every contract because it's a 10-point spread. That's your margin that you're going to have to put up, and that's the most that you can lose.
That's
So
not
if you do one contract, now you're going to say, Rob, this seems like the most screwed up strategy. You're risking so much more to make such little money. But my response to that, though, is I might be making less money and risking more, but the probability of me being more successful is greater.
Yeah, your probability that it expires out of the money is through the roof when you're talking 90+% here, like 94.
Yeah.
I know in my interactive brokers, when I pull up an option, it gives you the probabilities right there.
Right.
Yeah.
I mean, don't get me wrong. If I had unlimited funds, I would just you'd probably say, Rob, why wouldn't you just sell every option that you can find that has a 90% chance of expiring out of the money? I don't have enough capital to trade every one of those, but I'll tell you what, you can find lots of strikes in any stock you look that have a high probability of expiring out of the money. You may not make as much money, but it's still free money to me.
Yeah.
Anything with a 94% chance attached to it that you're going to make money, I consider that free money. Am I always right? No, there's extreme scenarios where I'm wrong. There's scenarios where it backfires. There's scenarios where Captain Orange comes out and says something and the market sells off because of tariff talks.
Yeah, but I take that 94% and to do a long call and your average probability of profit, 53% change.
Yeah.
Yeah.
Frank, I actually think it's more like 30%.
Yeah, actually, I think you're right on that. I've seen probabilities ranging between 30 and 38 or something. And a few of those trades I was considering, and I looked at that and I thought, nah, I'm not taking that.
There's
38% was quite common. There's a lot between 30 and 40, that's for sure.
yeah. So right.
Like when I was buying calls in Boeing, or going to, that was the same percentage. So what I'm trying to get at here is if we can take your strategy and the power of divergences, your Keltner bands and the HPS setups that Johnny does. Therefore, we're getting 70 or 80% correct as far as being able to predict the movement of a stock.
That's
Correct.
Yeah.
Get the best of both worlds going here. That's what I'm looking at doing.
So let's look at the daily in this thing with my Keltners. Unfortunately, I don't have any Keltners for quite a while to run into. But on the downside, if you're bullish, I don't know. Let's look at that trade. So you can collect 86 cents by selling the 160 put. You can buy the 150 put for 39. So 86 minus 39 cents. You could make 47 cents on every option contract. So if you do 10 contracts, that's 47. I'm sorry, that's
Order
$470.
submitted. Order
But your
filled.
5-minute buy
maximum
divergence.
Order
if you hold
submitted.
it till
Order
expiration,
submitted.
your maximum loss would be $10,000. So again, Rob, why the hell am I going to risk $10,000 to make $470?
No, that seems crazy.
It seems crazy, but when you put the power of probabilities in your hand,
Yeah.
and you know that long calls best are 30 to 53% chance of being profitable.
Right.
You know, how much you're really going to make on that? I bet you lose more on the option than I would make on. I bet you I'd make more selling that put than you would make buying that option, buying that call.
Yeah, in the long run. Yeah.
Correct. So, in that, I had that example
Tradometer
before.
NQ
Craft
oversold.
Money, if you're listening, you asked me when we were talking about Amazon the other day. You said if you're bullish on Amazon, why not just buy the calls instead of selling the puts? I said because the chance of those calls expiring in the money are 53%, and it's a debit up front. So why lay the money out to buy calls when you can collect the credit up front and sell puts and have a higher probability of being successful? Don't be scared by the risk, by what you're risking to what you're making. Not in this case, because this is different than making $1,000 on a long but risking $10,000 on the stop.
Right.
Because those odds are not good for you either. But when you're selling premium, the odds are in your favor.
Yeah, and you're going to sell enough premium over time that eventually your account's just going to reflect that and keep building, and you're going to build up enough capital to cover that occasional, one-off black swan orange hair event. Yeah, like you were saying before. There's always one of those in the crowd, but
And Frank brings up the perfect example. He says he has a smaller account, and you can do these in smaller accounts as long as you have the protection.
right.
You wouldn't be able to sell 1,000 shares of 3M, or I'm sorry, you wouldn't be able to do naked puts on 1,000 3M unless you have 167,000 divided by 2.
Yeah.
Order submitted.
So
Order filled. Order submitted.
80,
Order
83.5.
submitted. Order submitted.
Yeah. And that's just for one trade.
Correct.
Yeah.
Right. So if you want to spread, you want to take advantage of the conditions.
I might want to have like 3 or 4 of these going on at once, depending on what Johnny comes up with on his watch list and other factors.
Right. So you can't necessarily. Wow, I'm getting bad feedback, Joe.
Yeah, I hear that, but I can't do anything about that. I don't know what it's from. I think did someone have the radio on in the background?
Frank, do you have the volume up?
I have the volume turned up, yeah?
No, on your computer.
Yeah, we're hearing some feedback. Anyway, the flag here is. Go ahead.
I turned my volume down a bit, just to make sure it's not me.
All right, it's better.
That's perfect.
Okay. Yeah? Perfect? Okay.
Yeah. So Frank, you make a great point. With put spreads, you can do multiple positions because you have protection on all of them.
Right.
Whereas if you didn't, you'd have to have all of that money in the account up front prior to placing the trade.
Well, I'm sure for a lot of us getting into this, and for some of the newer ones, that's huge.
160.55. Yeah, CB, you're cutting your risk by 50%. But what are you sacrificing in premium that you take in? Or is there am I missing in the strikes here? Hold on. 160. Yeah, that's true. Frank, CB Trader is just saying you can reduce your risk by, buying protection closer to than the short strike. But again, it's just what you're comfortable risking, what the probability of success of that actually working out. And obviously, the further out you go, the less you're going to collect in income.
Further out, you're being further out on the expiry.
Well, further away from the further strike, the strikes that are further away.
Yeah, that makes sense. Yeah.
And it makes sense why it's less, because the chance of it expiring in the money are very slim.
What if we tighten up the expiry from 16 days to say for
9?
something like 7 days or 9?
Yeah, there's a 9-day one out there, so you can sell a 160 and
Order filled.
yeah. See, the CB Trader is saying this because right now the 150, like next week's 155s, 152.5s, the 150s and 149s are all within a few pennies of themselves.
Right.
And it's just the way it's just the way the spread closed. But there should be some other fluctuation in there. But yeah, in this case, CB, that's a great example. If I can save myself, if I can reduce my risk because I can find 2 option offerings that are the same offer price but at different strikes, it happens sometimes. So in a bigger stock, follow my logic, Frank.
Yeah.
In a bigger stock, if I can find, sometimes for just a couple pennies between strikes to pay on the offer, you're getting sometimes $2.50 or $5 difference in strikes. Does that make sense?
Right.
So
I've seen them priced that way too. It's kind of weird like that.
A 155 put and a 157.5 put might have the same offer of 25 or 28 cents. Sometimes they just get out of whack. And if you can pick that up, you can reduce your risk, and you have to put up less margin if you can find an equivalent protection in a cheaper strike.
Wow,
So
okay.
you really want to be diligent. So you might only pay for that $2.50 difference in strike prices. You might only pay 1 or 2 pennies more on the offer to buy them as protection, but you've given yourself $2.50 of cushion on the stock price.
Right.
Does that make sense? So that's what he's saying.
Oh,
CB Trader
yeah.
saying you're going to reduce your risk. When if you
That's
can
like-
find that, that's a great thing to jump on.
That's like free risk reduction.
Yes, it's like price improvement, which you never get.
Right.
Um,
Oh, that makes sense totally.
but again, it all comes down to how much are you willing to risk. I'm very risk averse. Most cases, I do go a little cowboy sometimes, but I would rather take less money and have a 95% chance of making money than collect a little bit more and have a 70% chance of being right.
Right. So yeah,
And
you trade your options a lot more risk averse than you would.
then I would trade the futures, right? Exactly.
Yeah.
So just as an example, somebody asked me on a PM, they said, what's the minimum that you would look for when doing a put spread? Depending on the stock, I would probably say between $120 to $300, $400 is a sweet spot for me on every trade, and hope to collect at least 90% of that. So about between $100 and $400 I'd like to make.
And how much would be your 100% maximum risk? Get that. Say 95% of the time you're not.
Wait, say that again, I'm sorry.
How much would be your maximum risk? And then, of course, you're only going to be faced with that very small percentage of the time, 5-6% somewhere in there.
I would still be comfortable. I'm not too concerned about that. The only reason of turning it into a spread is for the margin aspect. I'll evaluate any stock on its own merit.
Yeah, okay.
But to get into a trade, I might have to risk more to control that stock. But it doesn't matter because infinitely my margin will be reduced. Again, if I want to buy 1,000 shares at Amazon, it's going to cost me $990,000 to own it.
I also
Right.
I also like the fact that sometimes the stuff moves against you quickly. You took the other side, the iron condor method.
Correct. That's just one way of trading around it.
Right.
So you're bullish on the stock. You sell a put or you sell a put spread. Now it starts to go against you. What do I do? Well, you can cover the puts at either flat or you take a small loss. You can roll those puts and try a different strike and try to lay it out there and probably lose money in the interim. You could just buy puts.
Yeah.
But again, buying those puts is just like buying calls. Even if it's going down, you really only have between a 30 and a 53% chance of being right. So why not sell a call spread betting on it going down? Because the chances are the clock is still spinning. So you sell that call spread, you sold a put spread. You're starting to lose money on the put spread, but that call spread is now making money. One side has to win. And if you're lucky enough, like I was, you win on both sides. the thing about options, not to be general, but options give you options. It just makes.
How about this? Like you knew, for example, like say there's a big, say we had the non-farm payroll and you're doing this for options on the futures. But you use a strategy like that, you knew there was going to be a big move one way or another, you just didn't know which.
Right. Well, no. See, but my strategy.
That's not something I would actually try, but.
Yeah, but well, and granted, I don't trade index option. I don't do put spreads on index options. That's a Keldar thing. He does it every week, and same thing. He's picking up free money off the street because he's getting involved in stuff, and I think he shoots for like a 70% chance of success.
Okay.
He will make more than I will because he's taking a 70% risk, and probably by the time decay kicks in, he'll probably cover that significantly, that significant profit. Whereas the initial premium that I captured was small. He may still make more. He may capture more in decay than I will on my original way out of the money put.
Right.
If that makes sense. But Keldar is employing more risk than I am, or willing to accept more risk than I am.
Right. So he's making that calculation, but his reward will be proportionally, more based on that extra risk.
And in your example, Frank, if you made $200 on 5 positions over a couple of days, you can make $1,000 or more a week or in a few days, just based on betting where it's not going to go.
That's not bad for somebody, rolling on the road 50 hours a week that just wants to do the time. That's what I'm looking at.
Yeah, and this can be this would be as hands-off strategy as you want. I play in the high flyers. I play up until expiration. I play up until that closing bell every day, especially on Fridays. Because even on Friday, options decay.
And if they decay even more, like at a greater rate, right, on that last day, even though the last week put together.
Yes, as you can see on that, John, show that chart again. I hate to keep harping on it, but this is...
You mean the decay chart here?
Mm-hmm.
The decay chart, yeah. I understood. It's kind of like a parabolic type situation, right?
For the people that are struggling to understand this, just look at that picture that John's going to put on the screen.
I got it on.
Okay? This thing this is a non-linear move. It starts out further away from expiration. There's all that time in it. As it gets close to expiration, now the time component which made up the premium is gone. You've already captured that or lost it if you're long. But when it gets to those last hours and that last couple of days, that's when it really starts to go, I don't know. You wouldn't call that parabolic. You'd call that exponential, I guess. It exponentially decays.
Yeah, you got it.
So it exponentially decays as it moves closer to expiration, which makes sense. It is less likely that the thing is going to expire in the money. So there's less of a premium to it because there's less of a chance.
Right.
So what I like to do, Frank, and I've said this in the room before, I don't know if you've heard this, but a lot of times what I'll do is I'll pick a nice frothy stock that has frothy premiums, like juiced up premiums for whatever reason. And I'll, on a Thursday night right before the close, I'll sell puts. Provided that stock opens flat or even up a little bit, in most cases, there's going to be a 30% decay just from Thursday, 4 o'clock until 9:30 the next morning when it opens Friday morning.
Holy smokes, that's just overnight.
Right. And why do I do that? Because that's when the greatest decay kicks in is Thursday to Friday. Then Friday morning, once 11 o'clock hits, if you are a long option holder on Friday morning and you are not in a profit by 11 o'clock, I can almost bet you're not going to make money by the end of the day unless that stock has a awesome move. The odds are stacked against you just because of that time decay chart that you're staring at on Johnny's screen. That right there tells you you are at a loss. And you are going to quickly, that option is going to quickly lose value before the end of the day. Again,
Basically, yeah, you're like the losing football team making a Hail Mary pass on 11 o'clock on a Friday.
right.
Yeah.
So you're going for the end zone every play on Friday morning, hoping. And I'm just sitting there hoping that the clock keeps spinning. Because I know as that clock spins, the likelihood of you making money is impossible almost. And I'm on the other side of that trade. Wouldn't you want to be on the other side of that decaying premium?
Of course.
Again, selling rotting fruit. Think of me as your fruit man. Rob the fruit man. Bananas, here they are. Take them all. Take all my bananas today. Because I know in a couple days that thing's going to start rotting, and you're either going to eat it, meaning take the loss, or you're just going to hold on to it and hope that this thing gets better. And I'm sorry, rotting fruit does not get better.
No, it gets worse, and it gets worse quickly.
And just when you don't think it can get worse, it does.
Yeah.
The other thing I stress is do not, in almost every case, if there's time value left in it and you have a profit, take it. Because some people are going to get ambitious and they're going to try and go head to head with you. And there are times when you will get burned. But
So that makes sense. Have a good take profit strategy in place for you.
yeah, I've also been looking at, I did something I didn't normally do. Last week with Amazon, I sold puts on Friday, which I tell you never to do. And that's because the option market makers are smarter now. They adjust their option prices based on Fridays and Mondays. So,
Yeah.
if you
so
are,
might
if
be
you are,
able to win on that shtick in the past, but they got smart on you for that.
yeah, and now all of their systems they adjust their options for the weekend decay. So I stress normally do not sell puts or put spreads until Tuesday, because by Tuesday they've already adjusted, and now they're starting. Now decay is where it's really going to start, is Tuesday. And then a little more on Wednesday. Then Thursday is ridiculous. And that's why I like that capturing that premium from the overnight Thursday to Friday morning.
So start looking Thursday afternoon.
I would even start looking on Tuesday, say, all right, I like the way the stock is moving. I see the premiums are pretty fat still. Let me look at them on Thursday. Then about Thursday, 3 o'clock in the afternoon, you start to look for stocks that look like they're going to rally. Hopefully a Thursday afternoon, right? You get a big flush down. Then we rip into the close Thursday. If you start to see that thing starting to rip, sell puts in it. And probably by the next morning, should the stock open flat or gap up, you're looking at a nice profit. At least 30%, maybe 50% just overnight.
Wow, that's
And think about it.
each and every time, yeah.
Okay, so Frank, think about it if you did it at the money, what a hero you would be. But think about all the free money you just gave up at the lower strike prices that already had a 80 or 90 or 75% chance of expiring out of the money.
Right. As I
Opens up a whole new ball game, doesn't it?
Yeah. Yeah.
So, like I said, there isn't an end-all, be-all way to trade options. This is something I've just found is consistent. It works with my style. You guys know I'm a hit-and-run trader, and I like to take profits quick. But you can be as lazy or as ambitious as you want in this thing. Sometimes, I had an example a couple weeks ago. I traded Amazon. In a 5-day period,
Tradometer ES
I traded
oversold.
13 different strikes. Just selling premium and covering it. Selling premium and covering it. And I traded the range all the way up down. I told you it has a 29-point range every day.
That's the
Over-
average range each day. Yeah.
Yeah. So over a few days' time, I traded 13 different strikes. And you see they're $2.50 a piece. Or sometimes $5 strikes.
Okay.
So, again, I can't impress enough. 3 guarantees in life. Death.
Tradometer
taxes,
YM oversold. Tradometer
premium
NQ
decay.
oversold.
I promise you. You look at that chart, if that's not enough to get you thinking about it, I'm not saying to jump in. I'm not encouraging anybody to trade options. I'm just saying if you're not looking at options and learning what I'm talking about, you're really doing yourself a disservice because it's a very consistent, profitable strategy. And you can determine what probabilities you feel comfortable with.
Well, that was well said.
Can I use that
Thank you.
to kind of start wrapping things up here? Because I have to actually leave soon. I could leave you on, though. Rob.
Oh my God. Nobody wants to hear this.
No, they
cartoon
like
voice.
it. Do you ever do butterflies, Rob?
Johnny, that was awesome.
No, I don't. I don't want to be the It was actually Kenko who's yelling at me about going home, so blame him. But I kind of have to get home soon because I can get back here in the morning.
Money never sleeps, John.
Yeah. But man, what a great show! This was awesome. I mean, I got it recorded. I'm going to actually end the recording right now, and then I'm going to let me stop recording.
I feel like we didn't go over anything.
Are you kidding me? I asked a lot of questions. A lot of people that asked the questions. You want me to leave you on?